From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
So we are 120 minutes away from the opening bell, the last day of trading for the month of August, going into a very busy September. Equity futures positive by 0.4%, on the Nasdaq 100 up by 0.7%, on the Russell up by 0.5%. The S&P 500 actually poised for a week of losses as things stand, but still on course, Lisa, for a month of gains.
To me, one of the most interesting statistics, and we mentioned it earlier, but I want to mention it again, the Magnificent Seven stocks are almost 12% below their all-time peak. You can see right now that is what's holding this S&P 500 from another all-time high, because everything else is participating. I wonder how long we can get this reversal and how far it can go, really lifting the overall index if you don't get the participation of NVIDIA.
Does this smell like July? A little bit going into the August report for the month of July. August 2nd, we got this big downside surprise on jobs. Unemployment crept higher. We'd been talking in the weeks previously about tech was sort of left to the one side. We've got new leadership coming from the rest of the market. Does it feel like that moment all over again?
There have been head fakes with the rotation trade. How far away is this market from bad news being bad news? I think that's another way of putting the same kind of idea in terms of if we get a labor market report next Friday that's weaker than expected, does that torpedo the optimism that we're seeing baked into some of the recent performance?
Because a month ago, 3-4 weeks ago, we had this period of about 2 or 3 days of just really weak economic data. ISM manufacturing, the employment component, pretty unnerving. Then we saw jobless claims start to break out, payrolls almost reinforcing that view. Ever since then, week after week, economic data in America has been pretty decent. In the bond market, front end of the curve 2-year, 390. Longer end of the curve 10-year, 385.19, 30-year 413.19. Want to spend a bit more time talking about the commodity market. Need to spend some time on that. This came from Michael Harney of Bank of America this morning. The secular shift from a 2% CPI world to potentially 5% means the commodity bull is just starting. Said this, Lisa, 60-40 question mark. Commodities are a better 40. Commodities are, the view from Bank of America.
The idea of what is an inflation hedge, and inflation being a bigger problem potentially than some of the growth concerns that recently would bolster bonds. This to me is one of the most fascinating moments for inflation discussions. They've fallen off the map, which may or may not be valid. But at what point do you have to worry about the reignition of inflation at a time where basically this is a Fed, it's going to get ahead of weakness. You don't see much of a slowdown in the overall growth picture. You do see companies continue to earn profits. At what point do we start to worry about inflation again and look for assets that can accordingly balance out those risks?
Odd to have conversations about mission accomplished with CPI closer to 3 than 2. Of course, we're a long way away from 8 and 9, but certainly not quite mission accomplished yet, is it?
Well, it's not mission accomplished, and there are some nodes of inflation that a lot of people dismiss, housing inflation in particular. I am very curious to see that if rates do drop precipitously, does that cause housing to become more affordable or even less affordable, given the fact that lower rates have caused prices to go up? Again, idiosyncratic or a key component of this overall market?
It's my question too, it's everyone's. Does it have a greater effect on supply or a bigger effect on stimulating demand? And not many people know the answer to that just yet.
I don't think anybody knows the answer to that.
We're going to find out potentially in the next couple of months, and we'll have a conversation about it in just a moment. Under surveillance this morning, OpenAI could get another big financial backer. Sources telling Bloomberg that NVIDIA has discussed joining a funding round that would value the AI startup at more than $100 billion. Apple and Microsoft have also been in talks about participating. Remember those conversations about unicorns?
Yeah.
What's a unicorn? A private company with a valuation of more than $1 billion?
Yeah.
$100 billion. That conversation feels archaic now.
Yeah, well, and it's interesting that they're all participating. So it's all of the major companies that would be users of the product of OpenAI. This is a contrarian take. At first, it's sort of, what's the antitrust pressure and, behemoths that are kind of controlling everything. I'm actually interested to see, are they going to form some kind of commission to oversee the application of AI and to make sure that it's being done in a way that is responsible going forward at a time where we do not have an understanding of exactly how some of this generative learning and machine learning really comes together with the ideas. There is a black box component to artificial intelligence that has created some concerns. We saw that with OpenAI. Do these companies create a sort of reason to be responsible because it doesn't set any one of them back more than the other, or does it basically cause them to just gun it and go as far as you can because it's going to benefit every one of them at least, and roll it out faster? This to me is actually what I'm watching most closely.
We've had conversations that would last weeks on this program already this year based on the shovels of the gold rush that is AI, and not nearly enough of a conversation about use cases. Surely that's got to be the dominant conversation of the next year. What is the use case? What is the return on investment for some of NVIDIA's biggest customers?
I could not agree more. We are talking about potentially, we've seen this with search, we've seen this with respect to certain efficiencies in scouring through, say, earnings calls and some of the documents that people get, transcripts in terms of keywords. We don't see it in terms of how can you really create the idea of intelligence, analyzing data sets and coming up with predictive models that can be accurate without bias, and what that means in a society that has inherent bias. These are some of the questions that people have.
NVIDIA right now up by 0.9%. Let's turn to this story. One of Lisa's favorites, Lululemon, facing pressure as consumers pull back or go for baggier pants. The athleisure giant lowering its sales and profit outlook for the year thanks to increased competition and lingering inflation. But shares are actually up in the pre-market as analysts see the revised guidance as achievable. That stock is up by 4.5%. I've just gone through all the analyst commentary. Guidance for full year seems to be low and beatable. That's coming from Morgan Stanley, who are still overweight. Price target lowered just a little bit, but you see that almost on repeat from the south side after the numbers yesterday afternoon.
We're going to talk to Dana Telsey coming up, and she has a similar kind of thought. Key question to me is, how low is the barrier to entry for new entrants? And we've seen this with Nike and Adidas in terms of disruptors there. And we see this with respect to Alo and Beyond Yoga and Vori, which we've talked about excessively on this program. And there's a question of how quickly are the trends changing and how much lower are the barriers to entry given some of the social media actors, et cetera, and advertising in that vein. Key question to me is, how do you respond to that? Is it a matter of social media placement? Is it the fabrics? Is it style? How do you sort of get ahead of that at a time when, this is a company that's become associated with tight fits?
Fashion comes in waves, right? You see this with certain names that are on the edge of bankruptcy, and then 10, 15, 20 years later, they get a new designer and you have a big turnaround and boom, it's the thing of the moment. I'm thinking of, say, Gucci. Look at the arc of Gucci over the last several decades. Lululemon's just not that cool to people anymore. It just feels like it's got a massive brand problem. Burberry may be a better example of that over the last few decades. Remember the 90s where it was just associated with football thugs, and then 10, 20 years later, Angela Ahrendts comes on board, Mr. Bailey, the designer, things turn around, and then we end up in that soft moment again. Lululemon feels like it's just on the wrong end of a wave right now.
I just think it's a liability when something becomes too cool too quick, because then all of a sudden there are people who don't look for the brands. I'm just saying people who don't look at what the brand is. They actually don't want to be sort of branded by the clothes that they wear. They just want something that's comfortable and that looks good, and then they go for something that doesn't have such a clear association in society, and then all of a sudden things start shifting away.
Great example, and I know you're talking about yourself, so let's talk about you a little bit more. You watch the Olympics loads, right? Just like I do.
Yes.
You're inspired by the athletes. You're very ambitious, driven, aspirational, goals-driven. All of that. I totally get it. You work out a lot, physically in fantastic shape. At any point, after experiencing that moment after last month, did you go on the Nike website and think about getting some new sneakers? Did you think about going to Lulu and buying some new workout gear?
No.
That's a massive problem. That's a huge, huge problem.
Yeah. How do you associate a clothing brand with some sort of fitness that we all aspire to.
I think that's the most complimentary I've ever been of you. So there we go.
Very
Leave that
sweet.
there. All right.
Yeah, let's just be really honest. None of that's actually true, but carry on.
Lisa runs home every single day.
I do.
Vice President Kamala Harris telling CNN that economic issues will be top of mind, quote, from day one if she wins the presidency. That would include house affordability. Harris reiterating her proposal for a $25,000 tax credit for first-time home buyers for down payments. Jonathan Miller of Miller Samuel joins us now for more. Jonathan, Lisa and I were both looking forward to this conversation. Before we get into the policy from the Harris campaign, I want to start with the policy coming out potentially from the Federal Reserve. A key question we've all got, and we'd love your opinion, whether the effect would be greater on unlocking supply or stimulating demand. How are you thinking about a reduction in interest rates?
I'm thinking about it as a wash, that the idea that we're going to have more inventory come in with lower rates is going to be offset by the increase in demand. I don't think the picture changes that much from where we're sitting right now. And it's interesting because so much of the economic commentary surrounding housing is amazingly out of date just because of the yen carry trade situation in early August. It seems like years ago, but it's very sudden. And so all the data like pending home sales is showing a sort of a prior moment in economic history, I think.
Jonathan, can you tell me then your view on rents? Because I know rents, particularly in New York, things are really quite punchy. When it comes to unlocking maybe demand for purchasing, do you think we can unlock some supply for rents? Because the people that have been trapped in renting properties, particularly here in New York, and I'm getting personal now, do you think some of those properties will ultimately be left and available for people?
I do think that as rates come down, that the pressure will soften. The way to think about the rental market and the purchase market as competitors, and we've seen rents really pushed higher because over the last 2.5 years, mortgage rates have really jumped, and that has tipped the balance, pushed people in. I don't see this as a correction in rents. I see this as a slowdown in growth or stability in rents, maybe some decline, but certainly the tenants aren't going to be sort of realizing a tremendous influx of new affordability. I think this is a long grind.
Yesterday, U.S. pending home sales dropped to the lowest on record, or the gauge that tracks them. How broken is this market right now, Jonathan?
Well, it's extremely challenged, and I think the pending home sale data that came out doesn't reflect sort of buyer minds, buyer attitudes that were changed in the early part of August with a sort of a reflection on what recession risk is and what the Fed is going to do. I mean, after all, we're seeing in New York, for example, an uptick in contract activity disproportionate to the season. And you have to remember that consumers have been waiting for 2.5 years to make a decision. And it appears that what we're going to see, not just in New York, but nationwide, is as rents soften more because of lower mortgage rates, as more people go into the purchase market from the rental market, that we're also probably going to see rising housing prices as a result.
This is what we've been asking, exactly that, Jonathan, this question of will lower rates cause prices to go up or affordability to go up as well, right? This sort of two ideas. Will it get cheaper for people to buy homes, or will it become all in more expensive because even if rates are lower, the overall asking price and achieving price is going to be much higher? You sort of alluded to it. You think the price is going to be significantly higher.
I don't know about significantly, but I think the trend is we're going to see price growth continue. We are seeing more inventory come in. Some parts of the country are seeing more than others, but it is in a good part of the country, inventory levels are still well below pre-pandemic. And in those markets, you're going to see more price growth than you will in markets where inventory is at parity now.
There's this real question here about the pace of declines in benchmark rates and who it unleashes first, the supply or the demand. We've been talking about this. How low do benchmark rates have to go to unleash the supply? People who want to leave their homes, whether it's people who are retired, no kids, big houses, they want to downsize, or whether it's people who had kids and have no space and want to move, but have been locked in by their mortgages, whichever one you happen to be in. From your perspective, what is that rate, and does that unleash supply before it unleashes demand, or vice versa?
Right, it's sort of like a dance we're trying to orchestrate here. The way I think of it is, I think of it as it's incremental change, but once we, the rates, like on a 30-year fix, drops below 6%, if that's the case, I think visually that will have sort of a jumpstart effect to demand. I don't think the thing that I'm sort of conveying here, I'm trying to convey, is that I do see it as an offset for all the new inventory that comes in. I think we're going to see an increase in demand because both buyers and sellers are aware or looking at the rates. A seller that has been reluctant to list is going to become a buyer, and the lock-in effect that was holding them back, they've had 2.5 years to sort of think about it, and at some point, personal situations require action.
Jonathan, appreciate your time. Thank you. Jonathan Miller there of Miller Samuel on the housing market. He's talking about a long grind. Let's talk about the long grind. So when we talk about the lock-in effect, I think lots of you already know what we're talking about. The people like Ramo with very low interest rate mortgages who are basically locked into their home aren't going to sell anytime soon, because why would they take on a mortgage with an interest rate of around 7%. So the effective mortgage rate right now, which in America, ultimately we're talking about the average rate on outstanding mortgages, is 3.92. In 2022, essentially when the Federal Reserve started saying, hey, we need to start raising interest rates aggressively, that rate was 3.31. So the average rate, the effective mortgage rate in America has moved about 70 basis points in the last 2 years. That's the slow grind that Jonathan's talking about. Yeah,
as evidenced by the fact that home sales are falling off a cliff. They haven't revived. The fact that mortgage applications, sure, we saw a little bit of an uptick, but otherwise are flat on their back. Because why would anyone move or even sell if they know that they're going to get a lower price and they're going to have to get a higher mortgage rate to go in anywhere else? This has been the conundrum. How we unlock that map process is still somewhat of a mystery as people sort of understand that dance.
It takes a while to close that spread. We're starting to close that spread. Let's see how quickly we can close it. Equity futures right now on the S&P positive by 1/3%. The opening bell 1 hour and about 45 minutes away. Let's give an update on stories elsewhere. Here is your Bloomberg brief. Bloomberg reporting that Intel is working with investment bankers to navigate the most difficult period in its 56-year history. The chip maker said to be discussing a range of scenarios, including a split of its product design and manufacturing businesses, as well as the potential scrapping of some factories. That stock is up 3% in early trading. Dow shares trading higher in the pre-market. The computer hardware company reporting second quarter results that beat expectations, with particular strength in orders for AI servers. Dow forecasting third quarter sales in line with analyst estimates. That stock is up by more than 4%. And third seed, big upset at the US Open. Carlos Alcaraz suffering a shock defeat in the second round, falling in straight sets to the world number 74. The Wimbledon and French Open champion making his earliest exit from a Grand Slam since 2021. Big shocker in the last day.
Okay, no one wants to see my workout routine. They all want to see Alcaraz's workout routine, because that's way more interesting than anything else going on over here.
There was a first-round qualifier, I think, who played Carlos, who called him a specimen, quite a specimen.
Indeed.
Dude's jacked.
Yeah, well,
absolutely jacked, but he's gone home early, much earlier than we thought he would. Up next on the program, pressure building on the US dollar.
The dollar has clearly weakened in the last 5 weeks against the majors. As long as you continue to see better growth overall, there will be a strong bid for the dollar.
That's next. This is Bloomberg TV.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears. Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Stocks are firmer to close out the week, up by 0.4% on the S&P 500. The dollar just a little weaker on the session. The euro 110.86. Under surveillance this morning, pressure building on the dollar.
The dollar has clearly weakened in the last 5 weeks against the majors. One of the reasons this has happened is because the Fed has moved in a much more dovish, towards a much more dovish narrative in the last few weeks. Culminating with Powell's speech, but the European Central Bank and the BOE have not. Is the dollar going to continue to weaken against those majors? I would say no, despite the fact that we are seeing a lot of dovishness from the Fed at this moment. As long as you continue to see better growth overall, it will be a strong bid for the dollar.
So here's the latest. The dollar on track for its biggest monthly loss of the year, with markets bracing for a Fed rate cut next month. Jeremy Stretch of CIBC writing, with the easing cycle approaching, we think we are near the end of the recent multi-year period of dollar strength. We do still like dollar upside because of our view that 50 basis point cuts are not needed at this point in the cycle. Jeremy joins us now for more. Jeremy, welcome to the program. Just to give you the opportunity to build on that just a little bit more, the dollar bull market might be over, but ultimately you still think there's a little bit of juice left to squeeze. Explain that.
Yes, I think there is a little bit of juice left to squeeze. We obviously have more than 25 basis points priced for the September meeting. So I think that's where there is a little bit of a residual risk. So I think it's clear that we've seen a significant and substantive dollar sell-off through the course of the month of August. But I think we can and should see a little bit of a correction back towards maybe 102 in the DXY in the nearer term, because I think the data doesn't warrant any concern regarding a 50 basis point adjustment from the Fed. I think we're looking at purely standardized 25 basis point moves through the rest of this year at the next 3 meetings. And I think that will eventually provide some sort of dollar cheapening. But I think we've moved a little bit too far. We're seeing a correction. That correction probably has a little bit further to go. Euro dollar got overbought, as did sterling. And I think it's a case of looking for better levels to enter trade. So I think it is going to be the case that we see a little bit of a dollar recovery first, but then we start to see a generalized bid towards those higher beta currencies, which will benefit from the stronger growth trajectory that we're expecting into 2025.
Jeremy, it's been quite a month for the FX market. August 2nd, August 5th, I think is best described as a positioning shock. Just how clean, and I know it sounds a little bit cliche, but how clean is positioning now? How big is that dollar long still?
You're absolutely right. We have seen a very volatile period. We've seen a substantial repricing or re-examination of holdings in yen, for example. Clearly, that's been a big shift and a big structural deviation in terms of moves. We still have some fairly large structural positions in currencies like the CAD, for example, which is still incredibly short overall. But we have seen a generalized paring back in terms of those dollar holdings. So we are, I wouldn't say we're clean, but we're certainly less skewed in terms of aggressive positioning biases than we were certainly at the beginning of the month, as we are now coming into the end. But of course, we have this long weekend in North America, and then we will be very much focusing on next week's non-farm payrolls result.
Jeremy, all I can think about, maybe it's because we're right ahead of a long weekend, but all I can think about as you speak is it's never going to be this cheap for U.S. residents to travel overseas again. You can play it around the edges, but essentially that's what you're seeing, that it's going to become more normal in the future, even at a time where you could see some strength on the margins as we head into a volatile, choppy couple of months. Is that right?
Yes, that's right. I mean, I think it is very much the case that obviously on a longer term basis, the dollar has performed relatively well. We've seen a prolonged period of U.S. economic exceptionalism. That's really amplified dollar valuations, and so dollar resilience has been very much the case. So for those U.S. domiciled tourists, the dollar has gone an exceptionally long way across the world over the course of recent years. I think it is going to be the case over the course of the next couple of years or so that we are going to see a graduated moderation in terms of those dollar valuations. And I think it is going to be the case that also the exceptional sort of dollar performance, which has been supported by that reserve currency status, although we won't be marginalized, it will be the case that there will be a gradual and continual sort of long-term diversification away from those dollar holdings, which is a longer-term but gradualized process which will limit those dollar valuations.
The only fly in the ointment here is where else are people going to put their reserves, whether it's a central bank or whether it's an investor, considering the fact that there aren't a lot of great alternatives. It doesn't look like the euro region is poised for significant growth. Potentially the ECB could cut as much as the Federal Reserve. Where will that strength come from?
Well, you're absolutely right that that is the problem that central bank reserve managers have, that yes, they may wish to gradually manage down those domiciled dollar reserves, but the alternatives are not particularly encouraging or not particularly widespread. So that, in a sense, has been one of the reasons why the dollar has held on much longer than would otherwise have been the case when you consider the fiscal and current account shortfall. So I think it is going to be a very slow and graduated process. We have seen a modest pickup in terms of those euro reserve holdings from the lows that we saw during the Eurozone crises. We're a long way away from the sort of extremes that we were seeing in 2008 and 2009. So there is scope for a moderate pickup there. But of course, as you say, the ECB are going to be easing, although I don't suspect that the ECB will be easing at quite as fast a pace as the Fed. So I think that's certainly something to keep in mind, that we are expecting another 50 basis points from the ECB, but it's going to be a slow and probably a quarterly process as far as the ECB are concerned in terms of policy easing. So not as aggressive as we anticipate for the Fed.
Interesting. Jeremy Stretch of CIBC, thank you, sir. It's going to be the question I was going to ask right at the end there. Who eases more in the next 12 months, the ECB or the Fed? And Jeremy's indicating it's going to be the Fed. Well,
and this is the reason why you're seeing the ongoing potential for weakness there. I just wonder if that's true. Look at the data out of the euro region. What incentive does the ECB have not to lower rates more than the Federal Reserve? Honestly, I don't see it.
I feel you, but single mandate central bank. They've got to talk a certain way about inflation.
Talk, but act is a different maybe story.
We'll see. We'll see. Up next, Eric Friedman of US Bank, Dana Taussey of Taussey Advisory, Rob Socken of Citi, Gennady Goldberg of TD. From New York, this is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting in Bloomberg to talk about sustainability, about future of sales. No, Marcel, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The AI cycle is absolutely happening, and this trend is still very much ongoing.
You need to see some major shift in earnings dynamics or earnings leadership to see tech take a big step back here.
The bigger story has been some of the broadening out that we've seen in the market in recent weeks.
We're actually starting to see more stocks in the S&P 500 post positive year-over-year earnings growth now.
The need to rely on a single stock to power the market, I think, is diminishing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Snoozy morning so far. Things get a little bit busier over the next 90 minutes or so, so let's get straight to it. 30 minutes away from economic data in America, 90 minutes away from the cash open. Let's start with the scores. Equity futures on the S&P 500 firmer by 0.4%, up by 0.75% on the Nasdaq 100. The outperformance yesterday belonged to the Russell, the small caps, the equal weight on the S&P, another all-time high. The small caps up by 0.5%. There are your scores, some of the price action. Here's the next few hours, your day ahead. 8:30 Eastern Time. We get some personal income and spending data, core PCE. Then later on this morning, 10 a.m. Eastern Time, UMich consumer sentiment.
All we could say is that yesterday what fueled the rotation, at least at the beginning of the day, was this idea that you got the second read of the GDP that came in stronger than expected. I mean, yes, it is that kind of day or that kind of week where that's the kind of data that will really shift markets. And you saw initial jobless claims that didn't go up. It was the perfect recipe of immaculate disinflation. If we see inflation come back, suddenly will people care about some of these inflation rates that we're having coming up that otherwise have been written off as just a second side story to what we're seeing in the labor market?
Yesterday was a pretty odd session, wasn't it?
It was.
We had the NVIDIA news earlier in the morning. The stock was low, and then it started to recover. The broader market was doing nicely, particularly after that economic data. Then it all faded into the close. NVIDIA actually closed yesterday. If you are just joining us, and maybe you slept through the close yesterday, down by about 6%. At the close in yesterday's session.
Which is remarkable considering that we didn't see a bigger decline on the S&P, right? I mean, the fact that the other stocks did retain their lift. Yes, you saw NVIDIA sell off. Yes, you saw Several of the other tech stocks also fall out of bed. Otherwise, you saw resilience. And to me, that was the biggest story yesterday, even with a decline into close. This idea that people still believe in the recovery story. What would it take to shatter that? How much of a decline, let's say, in the headline labor market data, or what if we see a revival in some of the inflation rates?
You'd have to see bad data. And we did not see bad data yesterday. Just reinforced this view that the economy was in an okay place. Equities doing okay, up by 0.4. Welcome to the show. If you are just joining us, let's look at the bond market. In the bond market, we are poised for a fourth consecutive month of falling yields at the front and back end of the yield curve. The two-year yield, Lisa, still in at around 390. It's been a bit of a grind over the last month or so, but that grind continues.
Jay Powell just said it. I'm going to cut rates. I mean, he didn't say that, but he said, you know,
he basically
did. He said, you know, the time has come, which is basically we're going to cut rates. The time has come to start adjusting policy and talking about how no further weakening in the labor market would be welcome. They would like to see this labor market remain where it is right now. Given that, it makes complete sense that there is this rush into U.S. bonds, and we did see something like the 36th weekly inflow into bonds led by U.S. government debt. Question is, at what point do we see the long end start to perk up some other issues? We saw yesterday a messier 7-year auction, exactly as we expected, a little bit more pushback when it comes to longer term expected rates and understanding what the discount rate should be, what the idea of the fiscal overhang and some other pressures should be for longer term U.S. rates.
We'll spend the next hour getting you set up for the jobs report next week on September 6th. I can share the estimates with you right now. 163 is the median estimate in our survey. Those numbers just coming together still, but the unemployment rate is interesting. 4.3% at the last report, which unnerved a few people. Looking for that to come back down to about 4.2. So some questions and answers potentially on that through the next 60 minutes or so. This is your lineup. Coming up, Eric Friedman of US Bank as markets await core PCE out in just under 30 minutes time. Dennis Halsey of Halsey Advisory Group as Lululemon contends with consumer pressures and baggier pants. And Rob Sockin of Citi on why he's still expecting a soft landing. We begin with the big issue. Good news is good news. Stocks inching higher as data shows the economy is in seemingly good shape. But Eric Friedman of US Bank staying cautious, writing solid consumer spending and labor market dynamics continue bolstering economic growth and corporate earnings, but have both decelerated somewhat. Slightly constructive market signals and near neutral macro signals continue to warrant a cautiously optimistic bias towards equities. Eric's with us for more. Eric, welcome back to the show. It's good to see you, sir, as always. You manage client money, institutional money totaling, I think, something like 500 billion. Can you share with us how much of that has been in cash, just sort of lazy money getting rewarded in money market funds, and how much of that has started to be deployed over the last month or so?
Yeah, Jonathan, in a way, it's almost been like this nostalgic push from both institutional and wealth clients, just viewing that, hey, look, I can actually get something from the shorter end of the curve, so I'm going to stay there. And I think that, you know, we saw balances go up as high as 10.5% in cash. And that's really worked its way down to about 4.5 or 5% across our broad book of business. So that says to us that, look, investors are getting this idea of a repricing across the curve. And I think that effective pivot in Jackson Hole last week was all of the, you know, just the consensus view that, hey, look, we're not just going to have that nostalgic view in perpetuity. So we are seeing more of a gradual, let's call it, filtering into other parts of the marketplace. I thought Lisa had a really nice tweet, or X, whatever you call it these days, regarding flows into bond funds. We're seeing that. We're also seeing, though, an extension in other parts of the broader global macro trade. So that's been a positive. We think that probably continues for the next couple of months.
I think we just go with post. I think just post just works, but whatever. Eric, when that cash position comes down from, say, 10 to 4.5, 5, how sticky is that 4.5? Because certainly people are lining up on this program telling us that money's going to be deployed, Fed's going to cut interest rates, curve normalizes, you'll see that curve go out the curve and into equities elsewhere beyond fixed income. How sticky is that 4.5 from your perspective?
Yeah, we think it's pretty sticky. I think that the thing that would probably shift views out of that, hey, let's get back into the broader macro ecosphere, if you will, would probably be the idea of the back end of the curve really ripping higher. That's something that your team has done a really nice job thinking about. Like, what are the factors that would actually cause interest rates to go higher on the back end? We don't think there's necessarily an immediate catalyst. There's so much focus on when does the Fed start cutting, how deep will that be for the next couple of quarters. But we do think that what's on the horizon, as we get hopefully more specifics on policy, is the risk that inflation actually picks back up again. That's not something that I think is really being discounted in commodities. It's being something that we think is probably worth talking about as we get deeper into the third quarter and early fourth quarter, probably September 10th, when we have the first and maybe the only presidential debate. There will hopefully be a little more specificity about tax planning and also about spending planning. That could be the catalyst that sets up some of the noise away from Fed and the immediacy of rate cuts and into more of the, let's call it the inflationary considerations of policy, which we think is it's an undiscounted risk right now.
So just to put a bow on this, Eric, and I think these are all really interesting points that kind of challenge the idea that there's $6 trillion of assets in money market funds just waiting for the Fed to cut rates, and then that's all going to be unleashed into longer duration bonds as well as into stocks. It sounds like you're kind of challenging that, and you're saying a lot of this is very sticky. You actually saw the biggest month of inflows into cash-like funds over the past week, going back throughout the entirety of this year. You're saying that unless long-end yields go higher, that's going to probably stay, and that any kind of optimism you have has to come from elsewhere. Is that a correct characterization?
Yeah, it's very, very succinct and much more eloquent than I put it, at least. I think if you look at fair value, we think for the 10 years, probably closer to like 4%. We're at 385 right now. So in a way, it's almost like duration is too expensive to buy more of, but it's not too expensive to sell. We're kind of in that middle ground, if you will, where 10s, 20s, 30s, probably not a lot of issuance. Again, you did a good job of covering the auction yesterday. If you look at the net participation of buyers across most auctions, it has not been foreign buyers. So who is going to be the marginal buyer of longer term paper? Probably not the usual suspects, if you will. So again, with a 10-year at 385, we think fair value again is closer to about 4. We're in this position where without a lot of definite policy agendas from either party, we're in a bit of a no man's land, if you will, with that trade. So duration, we think, is probably a little pricey. We think that the unwind of cash probably goes elsewhere, and that will probably be more of a trickling type of phenomenon over the next couple of weeks and months.
To take this a step further, Michael Hartnett over at Bank of America was talking about swapping out commodities in place of bonds in the 60-40 portfolio because of some of the concerns that you're talking about. I don't know that you're going to say, 60 should be all commodities or whatever, what have you, but there's a question of whether you start to, on the margins, shift more into inflation hedges like commodities in lieu of some of the bond holdings.
Yeah, Lisa, I think it's a great point. I mean, if you look at the considerations on commodities, when you're in an environment like this, again, we run relative performance money. And so you're giving up about 35 or 40 basis points a month if you're invested in commodities versus bonds. That's a pretty big hurdle for an investor like us to think about. Now, one of the things that has really not worked, in fact, one of the few dislocations in markets right now is the petrochemical cycle. If you look at what's happening with things like natural gas, which is effectively known as the widowmaker for investors because it's so hard to trade, and also things like oil and other components of petrochemicals, you're in an environment where the carrying cost of being wrong is extremely high. So we don't think that now is the time to necessarily be really bold and take a huge amount of capital into commodities, but you can piece into it. Again, gold's really worked, silver's really worked, but industrial metals, petrochemicals have not worked so well. That could be interesting. Again, we'd be very incremental here, especially as you look for optionality on policy risk coming out, later this year. But again, you have to be mindful of that carrying cost, which is quite high.
And that's the reason why some of maybe the 40% of fixed income would go toward that, but not the whole thing. When it comes to the 60% or maybe even higher, if you are bullish on stocks, I am wondering how you are cautious at a time where the risks are bifurcated in nature. What does that mean in terms of how you're approaching allocations right now there?
Yeah, this is a space where, we are actually modestly overweight domestic equities and overweight equities overall in our portfolios. We expressed that since late April in equal weighted S&P. We were early, which means we were wrong. In the last couple of months, we've been right, which has really, again, been a benefit. But we think this is an environment, Lisa, when there's just not that much dislocation. Again, since you had the low print in the S&P at 9:31 a.m. on August 5th, which just spoke to how aggressive the position squaring had to be, there just has been such a quick reflexive move upward across all assets that this is about relative value. So again, we like stocks over bonds. We like equal weight over ag. We like equal weight over munis. but you have to, we think, kind of pair off as opposed to looking at large, deep dislocations that just aren't there in the marketplace. So we're cautious about taking really bold moves. We do think that collecting income is an interesting thing to do for investors. So things like municipal high yield, things like non-agency mortgages, even things like reinsurance and closed-end funds. That's a good way to pick up carry and kind of wait for more specificity without taking in a ton of directional risk, because there just really isn't a lot out there from a market dislocation standpoint to pick through, besides, again, commodities which just haven't done very well.
Equal way has certainly been working. Just to put a bow on it all, Eric, we've been asking this question all week just to set us up for Payrolls Friday this time next week. Are we just as vulnerable going into September 6th as we were going into August 2nd, or have things changed?
I think things have changed, Jonathan, in the sense of, again, that the taps on the shoulders with yen carry trade positioning, those have already happened. Now, again, investors have very short memories, and so we're not, naive enough to think that there isn't some, potential for being offsides. But again, to your point, if we saw something beyond consensus, which I think is like for a 160, 165 print, if you'd have to see something like sub 110, 100, we think, with also a pretty, not sharp rise, but let's call it a headline unemployment rate of north of 4.5, or 4.4, 4.5%, that would signal a little more weakness than perhaps is priced in. We don't think that's our base case. Our economics team is a little more bullish on what the print may look like, but I think that with positions squaring a little bit tighter than where it was back in the August print, we're not as vulnerable, but it would take, we think, a pretty significant downside surprise to drive markets much lower.
That would be bad news, and that would be bad news. Eric, thank you, sir. Eric Friedman of US Bank. Have a good long weekend. Sub 100K, unemployment of 4.5. Bad news is bad news.
That would mean that, yes, people would price in a 50 basis point rate cut, but they'd also price in a lot more weakness and maybe a challenge to this rotation trade at a time where these are the most leveraged companies to the cyclical cycle.
Might get a rally in bonds, but maybe not in stocks. Equity futures right now up by 0.5% on the S&P. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. The latest Bloomberg Morning Consult poll showing Kamala Harris leading or tied with Donald Trump in each of the 7 swing states. The poll also finding the vice president narrowing or reversing Trump's advantage on key economic issues. Elsewhere, the U.S. labor market is seen as growing just 0.4% every year through 2033, according to new Bureau of Labor Statistics projections. The annual rate translates to about 55,000 jobs per month and is less than a third of the pace of the preceding decade, with the main driver being slower population growth. And finally, McLaren will look to close the gap on Red Bull at the top of the Formula One standings when the Italian Grand Prix is underway in Monza this weekend, the Temple of Speed. McLaren's Lando Norris needs to make up a 70-point gap to championship leader Max Verstappen with just 9 races remaining.
Okay, I noticed a real bias in some of the stories that we've been playing for the third towards specific teams and sports, McLaren.
I didn't even mention Ferrari.
Yes. Okay. Well, there you go. You just mentioned it. Monza.
You've encouraged me.
Just in general, the Temple of Speed. Just saying.
The oldest racing track in mainland Europe.
Not that you know anything about it.
One of the fastest too. Yeah. It's a beautiful thing.
It's also like Florida. It's like Miami, right?
Yeah, just like Miami and the Vegas racetrack. Yeah, so much heritage. Up next, the morning calls. Dana Telsey of Telsey Advisory Group as Lululemon grapples with a softer consumer. That conversation up next.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a racetrack in a parking lot of the Hard Rock Stadium in Miami.
Okay, all right. Please write in with your thoughts on that.
I've been chewing over this for the last 3 minutes now. Okay. Equity futures right now on the S&P, firmer by 0.5. Let's get you some morning calls. First up, Loop Capital lowering its price target on Dollar General to 90 from 130. Talk about catch-up. The analyst saying the company's Q2 results were worse than expected and management's guidance cut was surprising. Cratered yesterday. Next up, UBS lowering its price target on Guess to 22 from 24, keeping a neutral rating after a tough quarter. The analyst seeing more headwinds on the horizon. And finally, Morgan Stanley lowering its price target on Lulu by $3 to $3.26. The analyst saying full-year guidance seems to be a low and beatable bar. Sticking with Lululemon, Dana Telsey of Telsey Advisory Group, maintaining an outperform rating following earnings, noting solid results and saying a reduced outlook comes as no surprise against moderated expectations. Dana joins us now for more. Good morning to you.
Good morning. Thank you for having me.
You've been busy. How many companies under your coverage have reported this week?
We had 22 companies report this week.
Wow.
Don't tell me about a slow week this week. It was anything but slow because we now have the pulse of the consumer.
Let's pick up on that word slow. How slow are things?
Things have slowed down. You want to call it discerning, you want to call it more cautious, whatever it may be. July was a weak month. August is definitely a little bit better, but the planning for the back half of the year has taken a tick down. And you look at the fourth quarter where you have 5 fewer days between Thanksgiving and Christmas, retailers have to plan cautiously. Some have called out, is that a 3% hit to sales in the fourth quarter because of those fewer days? It easily could be.
So this is the confusion that I'm having. You had personal consumption that was revised up in the second quarter. You have certain companies that are doing just fine. You see travel that still is going pretty strong. Where are we seeing the bulk of this weakness?
In a couple places. Look what you've seen with luxury spending. Luxury spending has slowed. You're not getting the international tourists come over. You're looking at discretionary spending in the department stores. Look at some of the Macy's numbers, the Dillard's numbers. They're weaker than expected. Look at Urban Outfitters. You have consumers that are intentionally spending, and innovation is driving demand. It's not everyone. Look at Birkenstock. They had very good results, double-digit increases. Take a look at Abercrombie. Hollister accelerated. You're still seeing strong double-digit gains at the Abercrombie brand. Look at footwear. Deckers, On Running. You've had innovation and newness drive demand. But look what you've also had. The off-pricers outperformed. 4% comps at TJX and Ross, 5% comps at Burlington. Look at Walmart and Target. The consumer's searching for value because they don't have the stimulus dollars they had a couple years ago.
This might be a bridge too far, but is this a lot of people who are higher income searching for more value, but the lower income families still actually really struggling? In other words, are we getting a signal from the fact that off-price places are doing well, but the Dollar Generals of the world are flat on their backs and can't get a break?
And it's a little bit of everyone. I mean, you take a look at the Dollar Generals, but look who's taking share. The Walmarts, the Targets, the Ross, the TJs, the Burlington, they all did well. Some of the dollar stores, they're cutting back on their rate of new store openings, Five Below being one of them. So it's more competitive. You take a look yesterday, Old Navy, and that search for value, it definitely feels what you mentioned. Every income level has turned the needle up a little bit on searching for more value.
Let's get to Lulu. Why is it up in the pre-market? Why is it rallying?
The reason why, because when you take a look at the reset guidance, the stock's already been weak. It's taken into account this already. And frankly, the guidance they gave wasn't worse than some of the whisper numbers out there.
So it's beatable, which is what we've heard from other analysts as well. Let's talk about problems. Where are they having problems?
It's
competition, execution, what is it?
It's the women's business. It is definitely a little bit of the execution of it, the newness in the product that's come out. And you can call newness in terms of colors, it's colors, prints, patterns. They need more of that. It's going to come in slowly. They redid the merchandising structure, and it sounds like they'll be able to react faster and drive more newness into the assortment.
How low has the barrier to entry gotten? I mean, we talk about competitors. We talk about Alo or Alo or however you want to pronounce it. You've got Beyond Yoga. You've got Vori. You've got some of these other brands that have more of the air of cool. And Lululemon no longer does. It's very sort of characterized in social society as like what it is. It's tight. It's a certain person, et cetera. Is this getting easier in terms of disruption that we're seeing more broadly?
I think there's always been competition. I think that all the competitors, everyone has their own personality, so to speak. I think of Alo as fashionable. I think of Lulu as technical functionality. I think of Sweaty Betty as affordable. So each of them has their own pulse, and you have to be able to cater to stay in your lane and cater to it. The fact that Lulu didn't have that newness in women's impacted their ability to drive conversion.
There's also a question going forward of how much is the weakness something that's just beginning at a time when we just got a note from Andrew Hollenhorst over at Citigroup talking about how he expects the savings rate to fall to an all-time low, that essentially people are spending what they've got left. They've already spent up the pandemic savings. How much do you expect this to be the last gasps rather than the weakest spot?
I don't think it's necessarily the last gasp. I think that their customer has money. It's where they're going to spend that money. Look at the experience versus goods element that's out there. The other thing that you have changing out there, look at other categories that have underperformed. Look at jewelry. Jewelry's been a weak performer. So they'll go there, but they have to see something they don't have in their closet already.
You know what I think of when I think of Lulu? Midtown uniform. I don't think of technical performance at all. I feel like that died in the pandemic, didn't it?
No, I think that people are basically still wearing technical and functional. I think that some of Lulu's merchandise, particularly for men, that ABC pant, that's showing up to work every day.
That was my point. That was exactly it. You picture the Midtown uniform. You picture athleisure during the pandemic. You don't picture, incredibly, you don't picture Alvarez.
I sense you disagree, Dana, but I just feel like there's been a real brand hit over the last few years. That aspirational gloss is sort of is off.
There's been more competition. They've gotten to a bigger base, so it requires more to beat the bigger base.
Got it. Dana, it's good to see you.
Good to see you too.
One of the best. I know, just an incredibly busy week for you. So
thank you.
Thanks for dropping by.
Anytime.
Dana Towsey of Towsey Advisory Group. Coming up next on the program, we'll speak to Rob Stocken of Citi ahead of payrolls next week, and we'll catch up with Gennady Goldberg of TD on this bond market. Equity futures right now on the S&P 500 firmer by 0.5%. In the bond market, yields up a single basis point at the front end of the curve, 390 on twos, on tens, just about unchanged at 385. And as the dollar heads towards one of its worst months of the year so far, the dollar against the euro just a little weaker again. Euro dollar 110.84 from New York City. You're watching Bloomberg TV.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while
This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Stocks on the S&P 60 minutes away from the opening bell and seconds away from some economic data in America. The scores look like this: up 0.5% on the S&P, up 0.8 on the Nasdaq, up 0.6 on the Russell. The small caps doing okay. In the bond market, 2-year, 10-year, 30-year at the front end of the curve. The 2-year 390, the 10-year 385, with some economic data, personal income, personal spending, PCE. Jobless claims was yesterday. We'll get more claims and jobs data next week. Mike McKee's going to be a busy man. Mike McKee, are they late again?
Well, they're a little bit late again, but here it comes. Personal income stronger than expected, up 0.3. Spending comes in as forecast, up 0.5%. PCE price index as forecast, up 0.2. That's up from 0.1 gain the month prior in June. On a year-over-year basis, headline at 2.5%. Core PCE up 0.2 for the month and up 2.6% for the year over year, which is interesting because the forecast had been a 0.2 rise, but a 2.7% increase for year over year. So that comes in a little bit better. Does it make a difference to the Fed? Probably not. These numbers come in pretty much bang in line. The news about personal spending, and we'll dig into that a little bit in a second, is good news in the sense that it suggests soft landing still in place. The question we're going to have is, how do people pay for this if everybody says that their personal savings are gone from the pandemic? I got to look at what the overall wage and salary numbers are in this.
Is it fair to say that with very few exceptions, ever since that August 2nd payrolls report, the data in America has been in line and pretty decent?
It has been in line, and I don't know whether, and I'm sure our guest will say that economists are getting better, but we had a lot of problems coming out of the pandemic, and now it seems to be a little easier to forecast. We're seeing much more in line with what the forecasts are.
Market's pretty snoozy here. No big moves off the back of this. Equities up 0.5% on the S&P, still up 0.9% on the Nasdaq 100. In the bond market, just to touch base with things in fixed income, the 2-year up a single basis point, Lisa. So the 2-year 390.
We knew this was going to be basically bang in line with expectations since economists have been doing this. My main question actually coming from this was something that Andrew Hollenhorst pointed out earlier in a note where he talked about how this ongoing spending, which we saw yesterday in the revisions to second quarter, means that savings rates are going to be coming down quite considerably. This is my question. How much are people basically spending and using what they have, not necessarily extra income or extra savings left over from the pandemic?
We'll come back to Mike for some more details on those numbers. Around the table with us, Rob Sockin of Citi. Rob, your thoughts on all of this, where we are and where we're going?
Yeah, it's a very interesting set of data. I think, as Michael was saying, feels pretty soft landing-ish for most of the data that we've gotten in August, outside of the early August period where you had that ugly ISM manufacturing, that ugly jobless claims, that ugly payrolls report. Since then, you've had strong retail sales, much lower jobless claims, revised consumption GDP that showed a more resilient consumer, and pretty good numbers today on the consumer side, alongside pretty good numbers on inflation. So to me, this is a pretty good mix of data. Now, there are those downside risks, of course. the unemployment rate's much higher in that last report. So we have to watch these things closely, particularly the labor market. But overall, I think a pretty good tone of data.
We say things like this is a soft landing. By definition, it's just a moment in time. And I just wonder what gives you encouragement or confidence that we stabilize around this kind of new equilibrium. Why is this the new normal?
Well, I think that's exactly the challenge, is growth was always going to moderate from where it was running in the second half of last year and earlier this year. We were running well above trend, and we're at an inflection point, and it becomes difficult to know, are you moderating into a soft landing, or are you moderating and then slowing down much more sharply? So, I'm watching a lot of the higher frequency indicators to tell me where that trend is going. Right now, jobless claims is a good example. They're staying pretty low, so I don't see a lot of deterioration. To me, that says more of a moderation than a sharp slowdown, but history tells you these things can turn pretty quickly, so you don't want to get overconfident. But right now, it's the most difficult point, I think, to judge these data.
What's more instructive for you at this difficult moment where we do get conflicting signals? Corporate earnings reports and some of the earnings calls, or some of this economic data coming out of the U.S. government?
Yeah, it's a great question. And I found in the past that the two usually line up well over time, in the sense that if you look at what you're getting overall from corporate earnings and then what you're seeing in the macro data, they tend to tell a pretty similar picture. Now, you've had a bit more divergence, I think, now, where a lot of the consumer-based companies are pointing to more concerns about the consumer than we're actually seeing in the macro data. But the macro data are much broader than any given company. So to me, I look at the overall spending numbers, and those seem to be holding up pretty well. So I take that as the biggest signal.
So in other words, more of the idiosyncratic makes sense to you when we hear certain commentary like what we were talking about with Dollar General versus systemic, or sort of the tea leaves. Is that correct?
Yeah, absolutely. I mean, there's no doubt also it's valuable to look at some of those corporate earning reports. I mean, for example, we've heard for a while that there are strains in lower income consumers in the U.S., and you see that in a lot of the macro data. We don't have that much great macro data to tell you what's happening there. So there you have to rely more, I think, on what the companies are saying. Those strains have not worsened dramatically over the last few years, but they're definitely there. So I think it gives you a better picture of the idiosyncratic. But for the overall macro picture, I think the economic data is the best.
I think we all remember a piece that came out in July from Bill Dudley, the former New York Fed president. He changed his mind. And in that piece, he talked about the self-reinforcing mechanism of seeing higher unemployment. It all starts to feed on itself. We saw in the confidence numbers this week that people are less confident to finding work. Yeah. Any sign of that starting to emerge, that self-reinforcing process of people starting to worry, pulling back on spending because of that? Are we in that moment? Why wouldn't we be in that moment based on that?
It's a great point. And, we've written in the past about this sort of stall speed framework where when growth slows a lot, it just tends to keep going in most cases. And one argument you can make for that is it's self-reinforcing, that consumers and businesses see the economy slowing and they pull back even more. Right now, you're seeing some moderation in those numbers, as you mentioned. Consumers are finding it harder to find jobs, relative to earlier in the pandemic. But I think a lot of those indicators are still at relatively healthy levels historically. And, so far, we're still not seeing it really in the spending figures that you're seeing the consumer roll over.
But should we be more interested in levels or change?
We should be interested in change. We should be interested in change. And right now, if you look at some of those consumer spending figures, they're moderating. You're seeing services consumption moderate. Maybe you're seeing some goods consumption pick up relative to that flat trend you saw for the last few years. So you definitely should be focused on the change. But right now, as I said, most of these data tell me the consumer is not rolling over and the labor market looks mostly to be moderating. Now, again, that could change pretty quickly, especially with these self-reinforcing dynamics. So I'm very interested to see where that next employment report comes. Even, for example, if the unemployment rate moves up again, even if it's for good, quote-unquote, better reasons that labor supply is increasing, I think the sticker shock of a 4.5% unemployment rate, something like that could really influence consumer expectations.
We've been talking a lot about the weakness in the consumer, and you've been telling us why you don't see it actually accelerating in a significant way. At what point do we have to start worrying about inflation again then? Or not worrying about it, but considering the fact that it might not go down to 2% and stay there if you do have an economy that's doing just fine.
Yeah, and I think with what we're seeing in the U.S., and we're also seeing this globally, I think the upside risks to inflation have greatly diminished. If you look at by component, food and energy inflation are running at or below pre-COVID levels. Goods inflation's running at or below pre-COVID levels. It's really about that services inflation, which is tied to that tight labor market. But as we've been talking about, a lot of those labor market factors have been loosening. And so I think you can have more confidence that that services inflation is going to continue to grind lower. You know, if the labor market were to somehow retighten and you see that unemployment rate fall significantly, wage growth accelerate, then I would start to get more worried that you could get a pickup in services inflation. But the way the dynamics are now, I think that upside risk has really significantly diminished.
Let's finish on Friday. We'd love your views on what to expect this time next week. When we sit here in a week's time, looking back about 8 or 9 minutes, and we've just had payrolls. The estimate is 163. The unemployment rate we're looking for is 4.2%. What do you think we should be focused on next week?
Yeah, absolutely. And, you know, our U.S. team, they're looking for an even weaker report than that.
They're looking for 125.
125, so a fair amount softer. And that's the big risk. As I said, we're at that inflection point. You know, that could be right, that things are going to slow down much more significantly. If you get a number like that, I wouldn't say it's, you know, definitely a sign that we're going to entering a sharp slowdown, but it's a much more worrying number than where consensus is. I would be focused really on what's going on in the household report with that unemployment rate, because again, I think, you know, we hit the SOM rule in the last report. More of it's been due to rising labor supply in this cycle than prior cycles. But, you know, if you get a significant rise there, especially if it's due to weakening labor demand, I think that's going to be a pretty worrying signal.
Rob, thank you. It's good to see you. Appreciate it. Have a great long weekend. Rob Sockin there of Citi. If you are just joining us, the opening bell is about 50 minutes away. Equity futures still positive across the board here on the S&P up 0.4%, on the Nasdaq up by 0.75%. The Russell, the small caps up by 0.6%. Yields drifting a little bit higher at the front end of the curve on a 2-year, up by 2 basis points. The 2-year 3.92. Economic data out just about 9 or 10 minutes ago. Mike McKee, just to revisit that economic data, what stands out for you?
Well, the thing that stands out for me is not in the headline numbers, it's the savings rate falls to 2.9%. Now, we had in 2022 1 month in the twos, but you go back to 2008, 7, 6, we did have the savings rate very, very low, and that was when we were getting into the housing bubble. Not sure what it means, but it does raise the question of where are people going to get the money to keep spending at the rate that we saw today, the 0.5% increase in spending. And the surprise in there is that we had a lot of spending on goods, goods up 0.7%, where services were up just 0.5%. So it's been the other way around. So people are still buying stuff, but the question is, can they keep it up? Wages up 0.3%, same as the prior month.
I'm so glad that you picked that out. I think that's fascinating, especially as we heard from Andrew Hollenhorst earlier, that's really his takeaway. We see stronger consumer spending that's upholding GDP. How long can that continue as that savings rate goes down what he calls more normal levels? At what point does it become abnormal?
Well, I think we are sort of below abnormal. If you look at the averages over the years, you're going to be somewhere in the high 3s to 4%. So we're below that now, which raises the question of what are people doing? Are they starting to raise the amount they spend on credit? And we've seen some evidence of that. We haven't seen it get out of normal ranges, but it's back into normal ranges. And where do we go from here?
Let's have that conversation right now. Gennady Goldberg of TD joins us for more. Gennady, let's talk about it, and welcome to the program.
Thanks for having me.
Payrolls Friday this time next week. What are you and the team looking for?
Looking for a little bit of strength. We've had quite a bit of, I would say, uncertainty in the last couple of prints. You've had some lower prints, certainly. We're looking for north of 200K. We're looking for a... not far north, I should say.
Still north of 200K.
North of 200K. And, you know, very importantly, a decline in the unemployment rate. You know, obviously lots of questions about the SOM rule being triggered, lots of questions about the direction of travel. The direction of travel is still towards weakening. But we are looking for a bit of noise in this data as we're going through this transition from very strong economy to, you know, whatever word you want to put on it, but maybe not quite so strong.
So 4.2 for unemployment again?
Exactly.
Something a little north of 200K on payrolls?
Exactly.
Where does that leave rates?
I think that leaves rates a little bit higher in the short term. I mean, you know, you've seen rates really rally quite dramatically over the course of the last month or so. And I think we've gotten a little bit ahead of ourselves. I think the markets are looking for definitely more than 25 basis points per meeting for the rest of the year. Some of that's going to start to get priced out as we get closer. And I think rates are going to nudge a little bit higher, maybe north of 4% on the 10-year. I think that's going to be a good buying opportunity for a lot of investors who've been kind of late to the game and actually getting long.
Well, how do we understand whether it's people who are late to the game who can plow in versus a head fake in the economy, that essentially everyone thought that we were getting some sort of weakening that we weren't getting, that was turbocharged by the Powell pivot that everybody saw at Jackson Hole?
I mean, that's the difficulty, right? We saw this back in at the end of 2023, where the Fed pivoted quite sharply. I think this is why they've been so cautious not to kind of overdo it. You know, the discussion of 25 versus 50. Why jump into this massive round of easing, scare the market, where, you know, it's really the direction of travel that matters to the Fed, I think. What you're seeing is mission accomplished on inflation, or something very close to there, and now you're worried about the unemployment rate. And if that continues to drift higher, you know from a risk management standpoint, you have to start pushing rates a little bit lower, gradually, but you're over tight. So the direction of travel, I think, is what matters to the Fed, not necessarily every single data point.
So not to extrapolate too much, but, you know, it's a Friday on a slow week when everyone's trying to understand things that are not understandable from any long-term trajectory. Pairing together what you're talking about with what Mike was saying, which is that the savings rate is heading to the lowest level, or has just reached the lowest level since 2022. And yet we're looking at a Fed that's going to be cutting rates. The U.S. consumer is not that leveraged. What is the fear here that we could be turbocharging a next cycle that will end in tears if you have already an okay economy and you're going to have a very low savings rate and you're going to have the ability to take on credit more easily with lower rates? That's been a bad recipe in the past.
Exactly. So, and I think that's what's keeping the Fed very cautious right now, that they're not keen to actually cut in 50 basis point increments. There really is no emergency as we can see it right now. But again, from a risk management standpoint, the direction of travel is towards a weakening economy, gradually, not significantly. And you're seeing this in the consumer. We all talk about the consumer. There isn't one consumer, right? There's all sorts of pockets. I mean, you saw the earnings from, you know, the likes of Dollar General. You're seeing lower income consumers certainly under a lot of pressure. Higher income consumers are doing okay. On average, and that's what the numbers give us, on average, the consumer is doing fine, but there are pockets of weakness here. And I think the Fed has to be attentive to that, because they do tend to precede bigger, longer-term kind of weakening in the U.S. economy. And I think that's why the direction of travel for rates is also to the downside as well.
Let's work with this. Let's go with your numbers for next week and push it through this bond market. Let's bring up the board. The 2 years at about 390, 10-year 388, 30-year, let's call it 415, 416. If we get your 4.2% on unemployment next week, something a little north of 200K, where's that bond market 5 minutes later? And I know this is crystal ball type stuff. I just want to gauge from you the kind of reaction, the magnitude of the move that you'd be looking for this time next week.
I could see rates moving about 10 to 15 basis points higher on that kind of reaction. Not necessarily on that day, but in the wake of that report.
But that's just the potential upside. Then you think it gets bought?
I do think it gets bought. You know, from my conversations with a lot of investors over the last few months, a lot of them have been very cautious, you know, to the earlier point, to jump into these markets with both feet. They've gotten burned, you know, back in December of 2023. They've gotten burned all along the way for the last couple of years. They're very cautious. They want to see the whites of the eyes of, you know, the downturn to really start getting long. A lot of them have been more cautious than they would otherwise be, even though they will acknowledge that the economy looks like it's starting to soften up a little bit.
So do you think we're just going to be range bound with just sort of these fluctuations back and forth for the remainder of the year?
I think range bound, but on a downward trajectory. I think that's the best way, you know, kind of a downward channel, if you will, in rates. The issue is maybe we've overextended a little bit in terms of the downward channel. I mean, we're looking for 10-year rates to finish the year at 3.4%. That might sound quite a bit lower, but it's really not. You know, a couple of week data prints and we're basically there.
What's interesting to me is a point that Eric Friedman of U.S. Bank made earlier in the hour, where he was saying people think there's a $6 trillion in money market funds and it's going to go flooding into longer duration. He isn't seeing that happening. He doesn't expect it to happen until there is some sort of material sell-off in the long end that leads to higher rates. Do you agree? Do you think that the money that goes into rates is going to come from elsewhere and we're going to see that money stay in money markets in cash?
Yeah, I think that's one of the biggest misnomers of money market funds. If you talk to the money market funds themselves, they will acknowledge that that trade almost never happens. There are very few people who take money out of money market funds and invest it into equities or very long duration fixed income. You know, a long duration trade for a money market fund investor is maybe going out to 90 days instead of 30 days, right? That's your extension. I think a lot of that money is going to come from elsewhere. It's going to come maybe from equities, for example, or it's going to come from abroad with foreign investors actually starting to put money to work. I don't think that money is going to flood out of the money market space. In fact, I think money market funds are going to continue to see inflows, albeit at a kind of a more modest pace over the next couple of years.
Because of the risk aversion associated with an economic downturn? Where does that money come from?
Mostly because I think, you know, for the last decade or so, we haven't seen massive inflows into money funds because rates were rock bottom. You know, even if the Fed goes back to, let's say, a 3% neutral rate, if there is a soft landing, that's still 3%. It's still a very attractive rate from a long-term perspective. A lot of investors will be okay taking that. Obviously not as great as north of 5% as we're seeing now, but most investors will be okay buying into that.
This was deeply thoughtful stuff and at times slightly contrarian, and we appreciate that. Thank you, sir. Yeah. Gennady Goldberg there of TD. Lisa, lots to chew on.
Especially because this really kind of coheres with the data that we saw yesterday. Money market funds actually had their biggest monthly inflows this year. It capped $127 billion of cash into those funds in the month of August at a time where people were saying, watch that money flood out of there into everything else. It's not really happening.
It's not happening, at least not in the way people expected. We are 41 minutes away from the opening bell. Equity futures are just about positive, a third of 1%. Let's give you an update on stories elsewhere. Here's your Bloomberg brief. The latest U.S. economic data showing the Fed's preferred inflation gauge rising at a mild pace and household spending remaining solid, suggesting policymakers are taming price pressures without causing too much pain to consumers. NVIDIA is said to be discussing joining a funding round for OpenAI that could value the AI startup at over $100 billion US. As sources say, Apple and Microsoft have also been involved in talks about participating. And finally, talk about a paycheck. Golden State Warriors star Steph Curry has agreed to a huge one-year extension to his contract that will pay him more than $62 million. It means the two-time MVP will become the fourth NBA player to pass $500 million in career earnings.
Can you imagine what they'd pay him to do a podcast on Amazon?
That's true. That's such a good take.
I mean, honestly, I think that this...
He should date someone in Oasis.
I can't even. Yeah, that's...
Won't go there. All right, let's
move on.
Okay, up next, your trading diary.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg
pull it together. Stocks are positive, a third of 1%. The opening bell 37 minutes away. As we count you down to the opening bell, here's the trading diary, the calendar for the week ahead. Monday, U.S. markets closed for Labor Day. Tuesday, we'll get S&P Global U.S. Manufacturing PMI plus ISM data. Wednesday, JOLTS durable goods plus the Fed's beige book. Thursday, ADP private payrolls plus another round of jobless claims. And on Friday, it's the main event. It's Payrolls Friday. Enough economic data for you.
Yeah, next week's going to be the beginning of a stretch for 2 months that's going to be very different than the past week. It's going to be chock full of all sorts of data as well as, of course, political events. To me, I want to understand where the balance of risks is for this market. Is it, to Gennadi's point, the idea of a potential sell-off of the bond market or a retracement of some of the Fed expectations that we've seen built in post-Jackson Hole? Or is it on the flip side with weaker economic data? Frankly, it feels evenly balanced.
Finely balanced.
Finely balanced, thank you. I can't even pretend to do Fed speak.
Mike McKee, let's get a final word from Mike.
Like,
let's move on.
She sounds like Jay Powell, though. So
oh, yeah, big time.
I mean, I'm excited for next week because a week ago I was at the center of the universe with Jay Powell, and all this week all I hear is NVIDIA. Nobody cared about the economy.
We're doing a payrolls party.
Now we get left out and forgotten.
Left out and forgotten. But next week we'll be busy, and it'll all be about the payroll indicators, the labor market indicators, jobless claims, JOLTS, your favorite ADP, and then, of course, non-farm payrolls, because the Fed has said, basically, we're looking at the labor market to make our decision on the 18th of what we do from here. And we've got pretty good news today on the inflation side. So unless something happens, it's probably not going to be a big CPI before they meet. So it'll depend on the labor market. We'll get a lot of clues this coming week.
This week we're looking ahead to last month, or in the last month, was pretty unsettling for a lot of people. Manufacturing ISM, the employment component of that, jobless claims, the payrolls report. Have we put all of that to bed? Is there anything outstanding for you that's still just a little bit unnerving?
Well, I think the surprise might be in the manufacturing side. We saw in the numbers today that manufacturing wages went down, which suggests some real weakness there. We'll see that in the ISM numbers coming up. So we'll see that. And on Friday, the manufacturing hiring. And those are higher paid wage jobs. So that could be an issue.
Just quickly, ADP actually has gotten some attention recently as having been more telling than other indicators in the past, even when it comes to just revisions. What do you make of that?
Probably coincidence, but I mean, they're all friends of mine over there at ADP, and I respect their work, but it's not supposed to be an indicator of what the payroll numbers are going to be. So if it's close, that's good. If it's not, I mean, do you want to bet your salary on them being close again?
Are we putting more weight on ADP? Is that what you're saying?
I don't know. I saw some examples of how it's been more accurate than some of the previous. Yeah. So, I mean, I was just wondering if there's any credence to that. And Michael said no.
Mike McKee, thank you, sir. Coming up on Tuesday, Marvin Lowe of State Street, Matt Orton of Raymond James, Anna Rosenberg of Amundi, and Brent Shuley of Northwestern Mutual. For all of you out there from New York City, thank you very much for choosing Bloomberg TV. Have a brilliant long weekend. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you were the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland he did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Futures higher after tepid PCE data locks in a September rate cut 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, marching on. Stocks close in on a fourth month of gains as latest inflation data reinforces bet that the Fed will start cutting in September. Meanwhile, Intel explores its options. The chip maker is said to be working with investment bankers to help navigate the most difficult period in its 56-year history. And shares of Lululemon bouncing back despite a sales slowdown. Increased competition and relentless inflation curb demand for its pricey yoga pants. Meanwhile, let's take a look at where markets are trading 30 minutes until the cash open on this Friday, the end of what's been a volatile week and a volatile month. You take a look at where we stand right now. Quiet so far. The S&P 500 up about 0.3% pre-market. A little bit more so if you take a look at the NASDAQ 100. Of course, we were higher for a lot of yesterday despite NVIDIA's drawdown. Then we closed lower. Now we're higher again. A lot of volatility. Meanwhile, you look for stability and you find it in the bond market right now. 10-year Treasury yields currently higher by about 1 basis point, Shonali.
Looking at some pre-market movers on our radar. Intel, as you've been talking about, now higher after Bloomberg News reported that the company is weighing options that include a split of multiple businesses, and Intel up pre-market about 6.5%. We will talk more about that stock throughout this hour. Lululemon shares higher despite reducing its full-year forecast. Morgan Stanley sees the revised guidance as achievable. Lulu now up about 3.8% pre-market, and investors are not being so kind to Ulta Beauty, which trimmed its sales forecast following weaker than expected second quarter results. Ulta really down a lot this morning, almost 7% pre-market, Katie.
So you have that dispersion underneath the hood of the index. But if you meditate on the indexes for a little bit, I think yesterday was actually pretty important and pretty interesting because, of course, when this show was on, we were talking about the resiliency of the S&P 500, even though you had those NVIDIA losses. By the end of the day, of course, those gains weren't able to hold, but still we closed exactly flat. It seems like this market maybe is starting to move past it's just about NVIDIA, it's just about big tech.
But is that broadening story enough to move that market higher? At the same time, you did see August be a positive month, but you did see a lot of carnage across the street. Pods of certain hedge funds closing with less investors and less leverage. Let's see how high we can go, Katie.
Well, maybe the Fed will save us. And of course, we did get some inflation data this morning, which would suggest it's the case.
And here to break that inflation data down, Michael McKee, Bloomberg's chief international economics and policy correspondent. At the end of the day, you looked at that PCE data. What did it mean in terms of expectations for how much that the Fed might cut in September? It looks like that hope of a 50 basis point cut is less realistic these days.
Well, it's less realistic, but the question is what happens next week with jobs, because that's now going to be dispositive. We see inflation is continuing to go away. Comes in as anticipated for the PCE numbers, both the headline and the core, up 0.2%. The core on a year-over-year basis comes in up 2.6%. That's lower than had been anticipated. Income's up 0.3%, and wages and salaries are up 0.3%, just a little bit more than last month. Still raises the question of how do people keep spending 0.5% per month? Does that continue? It does say soft landing in terms of the overall numbers. On a 3-month average basis, though, we are seeing PCE fall and continue to fall, and the Fed is now not, as Jay Powell said last week, not really going to worry about an outbreak of inflation again. The one thing you have to wonder about with all these numbers is the savings rate falls to 2.9%. First time in the twos since 2002, and that was only 1 month. Before that, to see a continual 2-point-something savings rate, you have to go back to 2008. So are we seeing people run out of money? Will the soft landing continue? What are people going to be spending when it comes to the fall and the holiday season? That's what we don't know.
And let's take this conversation to Wall Street, because one of our producers, Dan Curtis, points out that you take a look at the trading right now, sort of a tepid reaction to today's PCE figures. There was more trading around initial jobless claims yesterday, around GDP yesterday, and it feels like the focus for markets and for the Fed has really shifted to growth, to the labor market. It seems like inflation now, we're content to say that beast has been slayed.
Well, the Fed has been saying, and Jay Powell emphasized this last week, that the balance of risks has tilted a little bit towards the labor market now. Less so inflation. Inflation is behaving the way they expect it to. PCE is a number that is comprised of a lot of data that comes out of the producer price index and the consumer price index. So economists are pretty good at putting all that together and forecasting it. So you had that basically priced in today. There was no surprise. All the numbers came in pretty much as expected. So now we turn to numbers we don't know. That is the labor market numbers. We'll see jobless claims, JOLTS, ADP, and of course non-farm payrolls next week.
All right, there's always something to worry about. Mike McKee, really appreciate your time. Great to see you, and happy Friday.
Happy Friday.
Let's bring this conversation over to Ethan Devitt. She is Chief Investment Officer over at London CIV. And I want to talk to you about your personal balance of risks. Obviously, it seems like for much of the street and for the Fed itself, more focus now on the state of the economy, about growth in this economy, and of course the health of the labor market, rather than just inflation. Where are you viewing the most risk right now?
It's interesting, sitting here in London, we are really the exception that proves the rule a little bit with some of those indicators you cited. The Bank of England has not seen enough comfort in the inflation numbers. They're probably not going to cut in September. They'll wait till November. That, of course, has had the inverse effect on sterling as to what's currently happening with the dollar. Sterling is close to a 2-year high versus the dollar. And we are seeing sluggish economic growth here out of the UK, but we still don't think inflation has been slayed. So it's really the inverse. So I'd say what are we worried about is that maybe that could be a canary in the coal mine for the US. Is it the case that inflation really has been slayed, or is it so lagging that we can't tell? Your colleague mentioned the focus on employment numbers. We had that massive revision in US employment numbers to the tune of over 800,000 that barely got a recognition in markets, although it was discussed by quite a lot of commentators. So do we really know what's going on with unemployment and employment numbers? Do we really know what the effect of the immigration, the body of immigrants is on those numbers? Are they real and can they be compared? So I'd say there's still a lot of murkiness in the data, but clearly the Fed now, the expectations are built in. For even a 50 basis point rate cut, it seems as consensus, the markets will be pricing that for perfection.
Well, even if you're still worried about inflation and you add that on top of all the other risks out there, I mean, how does that change how you invest in this market? Obviously, it seems like a lot of people are just happy to price in Fed rate cuts to a great extent. Where do you fall on that?
Well, rate cuts have that complex effect on what we have as a strong component of any portfolio, which is real assets. So real assets have always been the inflation resilient piece of a portfolio. And when we do see rate cuts coming, that of course boosts real assets such as real estate, particularly residential real estate. It just loosens up some of the investors to invest in other real assets because it lowers the bar, essentially. The bar for real assets is what could you make on a risk-free bond. So if that's coming down, that then frees up capital to go elsewhere into bond substitutes, such as dividend-paying equities. We've already seen that. And then income-yielding investments such as infrastructure, real estate, real assets such as forestry even. So I think that actually we're quite used to some inflation in a portfolio, and that's how we would invest accordingly.
At the end of the day, I do feel like a broken record, even for constantly asking about this, but the consumer story is becoming increasingly complicated with rates at this level and from feeling the pinch of, yes, inflation moderating, however, prices being much higher than they were years ago. You see it in some of the earnings reports already, and market is on tender hooks here when you think about the jobs report next week. Where do you think most of the pain will continue to come from the consumer sector that may not be priced in right now?
We're going to see discretionary spending coming down. And you rightly pointed out earlier that we are looking at this big question mark around retail sales around the holidays, because that's when the biggest ticket items would come. We've seen reasonably steady demand, and that's been surprising. But where are we hearing about demand fluctuations? But areas like, say, Airbnb, we're hearing about that. We're also looking at some of the demand projections coming out of the earnings picture, not all of them looking so rosy. Yes, the savings rate is lower, but maybe the savings level is still high post-COVID. The savings rate's lower because the consumer is being squeezed. We know they're paying more cumulatively for what they're purchasing, and also that if they do want to buy a house, for example, mortgage rates are a lot higher. So the consumer definitely is under some pressure, and we hear that from all of the company reports. What's boosting companies right now is the fact that they've been able to cut costs. They're being rewarded for that, and that is shoring up margins. So we will all hear about this now as the election progresses in the US. The economy is going to be the biggest issue of this election, and how it's faring is going to be under the microscope.
Even where does the housing market in particular matter most? Buying a home, paying your rent is a big part of a consumer's pocketbook right now, a big part of their wallet. And at the end of the day, even if you have mortgage rates coming down, 6.5% or near 6.5% is still a long way to go from that sub 4% that many consumers are still sitting with at their current homes. People are not getting out of their homes at a 6.5% interest rate. We're seeing that sluggishness still. So where does that have a ripple effect across markets?
Unfortunately, what we're seeing is that no matter what happens in terms of demand and supply, and we do think with mortgage rates coming down, that's going to unlock some of the frozenness really of the housing market, that there will be more sellers coming to market, more buyers able to come to market. But equally, if mortgage rates come down, that then gives a boost for sellers to keep their prices high. And we've seen that prices are continuing to rise month on month. There has been no let up on that. So the affordability issue on average is a problem. Of course, different areas of the country treat it differently. But remember, there is that mortgage and interest, the tax deduction there for that. So that could be something that many residents have missed out on because they've been forced to rent while they've been waiting to buy a home. So definitely affordability is a problem. It's not nearly as much a problem in the US as it is in parts of Europe, though.
Yeah, that's good context, global context, since we spend so much time talking about the U.S. housing market. And I want to switch gears here because, of course, we're talking about the Fed, and tech has been the story of the week. But another news item that crossed this week, of course, was Berkshire Hathaway crossing $1 trillion in market valuation. I believe the first non-tech company to do so. And Ethan, I'm just curious how you received that news, because I feel like an optimist could extrapolate that out as maybe some hope for the value investor.
Exactly. Well, the classic get-rich-slow story, looking at company fundamentals, companies that have moats, that has been the Warren Buffett mantra for decades now. I think he just turned 94, so clearly going strong in terms of that mantra working. But then we just looked at Ulta numbers. He took a stake in Ulta recently, and the Midas touch maybe will be a slow burn as opposed to something that we see immediately reflected in that company's stock price. So clearly the Oracle of Omaha is very much under scrutiny of everything he does, whether it's selling down Bank of America, selling down Apple or buying into Ulta, it's seen as an indicator of perhaps good value, as you pointed out, or just a strong fundamentals on the part of a company. So as we see this evolving, and clearly there is a belief in this rotation in value stocks, in bond substitutes, as I mentioned, I do believe that we're going to see an encouraging depth and breadth being built into markets.
Absolutely fascinating. Ulta down, Berkshire still up pre-market above that $1 trillion level. Value perhaps of diversification. Ethan, we thank you so much. Ethan Devitt is Chief Investment Officer at London CIV. A quick check here on futures, because as we've been talking about volatile intraday trading here, but we are starting today in the green. The S&P futures up almost 0.4%. NASDAQ 100 futures up about 0.8%. Russell 2000 getting a bid as well, about 0.4%, Katie.
And we'll see if we can hold on to those gains. We'll keep an eye on that. And we're also keeping an eye on Intel, as Bloomberg News reports that it's working with investment bankers to help navigate through a historic slump. That's coming up next. This is Bloomberg.
People, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
And now to high interest, a look at what's making headlines around the world. If you're an investor pursuing a 60-40 strategy, you might want to keep the ratio, but drop the bonds. Strategists at Bank of America are urging portfolio managers to swap commodities in for fixed income, as the asset class tends to perform better in a period of prolonged high inflation. Very similar to what AQR is saying, by the way. And ANZ Group, one of Australia's largest banks, is re-examining its alcohol policies after complaints of inebriated staff on the trading floor. The policy review comes as part of a broader look into allegations of cultural problems at the banks, and 3 people have left the bank following reports of bad conduct. And there's about 2 months until the U.S. general election. Vice President Kamala Harris joined Tim Walz in an interview on CNN, and here's how she described her economic agenda last night.
I would. I think it's really important. I have spent my career inviting diversity of opinion. I think it's important to have people at the table when some of the most important decisions are being made that have different views, different experiences. And I think it would be to the benefit of the American public to have a member of my cabinet who was a Republican.
Meanwhile, we're also taking a look at shares of Intel because Bloomberg News reporting that the company is discussing various scenarios with investment bankers, including a split of its product design and manufacturing businesses, as well as which factory projects might potentially be scrapped. And I will add, this is according to people familiar with the matter. Let's get more detail now from Bloomberg Technology's Ed Ludlow joining us from San Francisco. And Ed, when you consider the Intel of yesteryear, it's stunning that we're even having this conversation. So just give us some context here about who Intel used to be and how we ended up to where we are today.
Yeah, we talk about the semiconductor industry here on Bloomberg Television more than we've ever done, probably. It is in vogue, essentially. But Intel is at the core of the semiconductors history. And we use the phrase chip maker as a blanket term for all of the names that we talk about, but that's actually not quite right in many cases. It is definitely right in Intel's. Intel designs its own products, specific processors and chips that do specific things, but it also manufactures them, while for a large body of all the other chip makers, other contract manufacturers do that for them. TSMC is the world's biggest contract manufacturer for chips, and Intel was the leader in both fields for so long, designing chips that do stuff and then building them. And that is no longer the case in either sense, and it is in financially perilous territory where it's trying to work out how it can regain leadership in both branches of its offering.
Now, it's interesting, Ed, because Bloomberg has reported that they're working with their longtime investment bankers, Morgan Stanley, Goldman Sachs, to find options for the firm here. There's a reason that this is one of the most read stories of today, and it's because it could have a lot of Wall Street tied up into this turnaround story. What are the options out there for Intel?
Yeah, and you know bankers, and you know that bankers worth their salt. Goldman and MS have been with Intel a long time. Look at a broad range of options. The nuclear option is to sell off or separate the foundry business. That is the business of being a contract manufacturer of semiconductors for others. Right now, Intel's foundry business has one customer, and that is Intel. And what it wants to do is sell to others. So that is in the pipeline, but I think that what we're hearing from sources is they've just got to continue cutting back. They have this huge, ambitious turnaround under Pat Gelsinger that involves lots of expansion. And that expansion, bearing in mind the context of the $20 billion it got through the CHIPS Act, I think they'll start cutting back on some of those plans.
Yeah, it seems like if you look at sort of the sell side reaction here, that it seems like one thing is certain, and that is that they're going to cut back on CapEx over the next year or so, Ed. But, I mean, couch this in the competitive landscape. Of course, we just got through NVIDIA earnings. You had that great sit-down with CEO Jensen Huang. How steep is the mountain that Intel has to climb here?
Well, the question is actually whether or not it's insurmountable. So let's take the market for AI accelerators. This year, NVIDIA will sell $100 billion of high-performance GPUs, or AI accelerators. Intel, if it is lucky, will sell $500 million. We're talking two completely different scales here. And when I spoke to Intel's CFO immediately following their last earnings, the first concession or admission he made to me was that they weren't at the races with GPUs. For a long time in the context of data center, they were the leader, but they were largely focused on CPU, central processing units. GPU is now the brain of the data center, the high-value prospect. And so they had to be honest about that and say, we're not in that market enough. On the foundry business, again, it's a very simple case study. Intel has one foundry customer, which is Intel. TSMC serves everyone else, and there are some others like Samsung and Global Foundries. And they have not yet shown evidence of booking any third-party customers. And that's the only way to stem the losses in that foundry unit, actually start doing business with other people.
Ed, really quickly here in like 20 seconds, how vulnerable is Intel? Because there were prior reports about worries about an activist investor potentially attacking this stock.
Yeah.
Do you have an analyst telling us the model is effectively broken?
Yeah, I just cite the line in the Bloomberg story by Ian King and our deals colleagues that Pat Gelsinger is running out of time.
Bloomberg Technologies' Ed Ludlow, we thank you so very much for your time. And Katie, it's so fascinating here because you have to remember that so much of Wall Street, despite Morgan Stanley and Goldman Sachs, are already so invested in this story. Brookfield, Apollo have already done deals with Intel. Apollo's deal was an $11 billion deal, one that was not only record-setting for this kind of deal, but also landmark and really guiding the way that Apollo thinks about doing deals in the future. A joint venture here to really expand on AI capabilities and factory networks here and really think about expansion.
Yeah, it'll be fascinating, of course, to see how those discussions evolve. I'm glad you asked about activists. What a phrase there. Also in the story, I mean, there's the possibility of M&A here, and of course, we know there's a potential split up as well. So the board meetings in September, it's going to be really fascinating.
Turnarounds are indeed costly. Now coming up, Intuitive Machines wins a NASA contract for a mission to the moon, South Pole. I'd like to be there too tonight. Social Climbers up next. We'll talk right about that. This is Bloomberg.
Lunar lander. Vehicle pitching gun range. Stage 1 propulsion is nominal.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, to infinity and beyond. Intuitive Machines won a nearly $117 million contract from NASA for a moon mission in 2027. The space startup, remember, went public last year and launched its first lunar mission back in February. Next up, Autodesk raising its full-year earnings outlook following pressure from activist investor Starboard. Starboard has been pushing Autodesk to increase its margins and boot its current CEO. And finally, Dell reporting second quarter results that beat Wall Street expectations with particular strength in orders for AI servers. Dell Technologies COO Jeff Clark joins Bloomberg Technology at 11 a.m. New York time. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Sonali.
And a check on futures here. Before the market open, we have a green day. S&P futures higher about 0.4% ahead of the market open. NASDAQ 100 futures up 0.8%, almost 0.9. Russell 2000 up more than 0.4%. And of course, it's a fascinating week ending August in the green, but not without its choppiness. A clean day of PCE reads, but a busy week of economic data ahead. Now, coming up, we're going to talk to Adam Hetz of Janus Henderson about his S&P 500 call. Stick with us for that conversation next. This is Bloomberg.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
All right, we are moments away from the official start of trading, 22 seconds to be exact, until those bells really ring and trading opens up on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at futures right now, pretty much green. You can see that across the board from big to small, which is amazing when you think about the volatility that we've seen in the past week, in the past month, really all summer long. But it looks like we're going to close out this trading week and this trading month with more gains on the screen. You can see, of course, the companies at the NASDAQ and at the NYSE's clapping right now, of course, as trading officially kicks off on this final trading day of August. You take a look at where the major averages are trading right now. Officially, we can say we do have green on the screen. The S&P 500 currently up to the tune of 0.5%. Even more so if you take a look at big tech. We had a really weird volatile day yesterday with NVIDIA's fluctuations, but right now up by 1%. And the small caps also getting in on the action. The Russell 2000 currently up about 0.4%. Now, one stock to keep an eye on at the open is Intel. Remember that Bloomberg News reporting the company is discussing various scenarios with investment bankers as it struggles to appease investors. It may split its product design and manufacturing businesses, as well as put some factory projects on hold. This is according to people familiar with the matter. You take a look at the reaction in shares right now, and it seems like there's an embrace of that possibility. Intel currently up about 5%, Janali.
A few other stocks we're watching as the market opens here. Marvell Technology up more than 11%. This chip maker is soaring after strong second quarter results and a promising revenue outlook. Analysts are noting that demand for AI products for this company is fueling growth. And Lululemon higher. Despite lowering its sales and profit outlook for the year, the company cited increased competition and inflation. But analysts say the guidance cut was already baked into the share price, and you now have Lululemon up more than 2% as the market opens. And for more Lululemon, we're going to be joined by Poonam Goyal, Bloomberg Intelligence, a senior analyst for e-commerce and athleisure. And it's interesting, if you look at the headwinds, yes, maybe they have been baked into the price here, but are there perhaps headwinds that the market is not seeing that could meet this company in the coming months?
Sure. I think, what we really need to focus on here is the product. So they talked a lot about traffic being positive both online and in stores. So it's the conversion that fell short. And that was due to missteps in women's where they didn't have the right silhouette. They didn't have the colors, the patterns. So really what I'm watching for over the next 3 to 6 months is that reintroduction of colors, silhouettes, patterns to see if the consumer is responding. And if that's the case, then I think, they'll continue to move forward. But if we don't see that, I think there could be more missteps leading to possibly even lower results.
Poonam, I was saying to Shanali before this block started that, full disclosure, I really like Lululemon. I really like Peloton. I use both of those brands very frequently. I know you don't cover Peloton, so I won't ask you, but it's interesting that you do have all of this brand recognition when it comes to both of these companies, and yet you take a look at the stock performance, you wouldn't necessarily know it. And to your point, when it comes to the branding and the silhouettes, et cetera, you have Jeffries out with a note saying that maybe the brand has peaked now. Maybe style is shifting. And you think about sort of the re-embrace of baggy jeans, et cetera. I mean, how difficult is it for Lululemon just to keep up with current fashion trends?
Well, they're trying, right? So they're trying to go beyond that Align legging, right? They're introducing baggier fit, more casual fit in men's and women's, and it's going to take time. That's not what Lululemon is known for. They're known for that wear to the run. You know, that's what you're wearing to the yoga studio. That's what you're wearing to the gym, but not necessarily when you're just hanging out with friends or going out. So they're trying to change a little, but I wouldn't expect them to change too much. I think there'll be a balance. But the customer does love the brand, to your point, and I think that's the one thing that's going great for them. It's if they get the right product, I think they'll do just fine. It comes back down to product.
Very hilarious that you say that, because I was just telling Katie that my spending power has moved, and I love Lululemon as well, from Lululemon leggings to cowboy boots this year. But at the end of the day, another thing that I'm interested in here, you had Lululemon, for example, invest in different things, right? Like footwear. But at the same time, you see brands like Abercrombie and Fitch also moving into that athleisure category. Are they just facing more competition for this lifestyle brand that is attracting attention elsewhere?
Yes, so definitely there's more competition in the competitive landscape. But that said, I would also say that athleisure is growing as a whole globally too, right? Whether it's international or here, more people are more active. They are going to the gym more. They are spending time outdoors more. So it's a category where everyone can gain share, but competition will be tougher as everyone, not just Abercrombie, but even the Amazons, the Walmarts, the Targets, Alo, you know, you name it. It's coming from everywhere, high to low end.
All right, Poonam, really appreciate your time. Of course, Poonam Goyal of Bloomberg Intelligence talking about Lululemon down just an absolutely punishing 49% year to date. We're going to continue to follow that story. But let's broaden out this conversation now with Adam Hetz. He is global head of multi-asset over at Janus Henderson. And I won't ask you about Lululemon, of course, and whether you shop there, but I do want to talk about market fragility, because back in June, you highlighted that risk factor and you said that a 10% correction is more likely than not. You think about July, you think about August, and all the volatility that we've seen. Are we past the worst of that correction?
Well, good morning, Katie, Shanali. And I might have a little bit of Lululemon in the closet, but moving on back to my last time as a guest in the show, and thanks for having me back. Yeah, that was mid-June. I talked about the fragility in the market. To your point, I talked about the likelihood of a 10% correction probably being more probable by the end of the year than not, but still thinking we'd end positive for the year. And then mid-July, that fragility in our view translated into that 8.5% drawdown that finished off early August. So our view at this point is the market did pass a bit of a test. We like 5,600 a little bit better this time around, but with this round trip that we've had, we're also back to a lot of the fragility that drove that sensitivity that triggered that pretty abrupt drawdown that we saw in mid-July.
So we're standing here the last trading day of August, and everyone's coming back from a Labor Day weekend next week, and you have a new setup, one where the election is around the corner, one where a little bit of leverage has been popped out of the system this month. So how do you expect the story to go from here? Who's going to be investing in the market when we come back, and how will they be investing in it?
Well, on the note of coming back, it's nice having the data print this morning as far as PCE and the consumer. I think we can check that one off. It's a nice print going into the long weekend. And then now we're looking forward to a week from today with NFP, the non-farm payrolls, the 11th CPI. That leads up to potentially historic decisions on September 18th. So our base case here is that the S&P should and could just grind higher from here. And most investors will continue this broadening trade that's fueled by solid GDP, the broadening into better earnings. But I think there are a lot of risks out there that we have to remind ourselves we are in this late cycle environment. For example, earlier in the year in our model portfolios, we saw more of a mid-cycle true re-acceleration in the economic data. So we broadened our portfolios down in cap, international, more of those cyclical markets. At this point, we think the bar's a bit higher to add risk from here. So we want to see how this Goldilocks narrative ensues from here. And if that's challenged again whatsoever, that fragility across earnings expectations, where current valuations are, it could drive another drawdown before the end of the year.
Well, let's talk about where we are in the calendar year as well, because if you crack open the Stock Traders Almanac, September has been the biggest percentage loser for both the S&P 500 and the Dow Jones since 1950. You think about those risks ahead that you neatly laid out for us. Are you expecting history to repeat itself here when it comes to the seasonality effect?
Well, maybe I can do you one better on history lessons. If we're going back to the 1940s on GDP, as we were thinking about that 3% GDP print last quarter, we don't think there's a whole lot of forward-looking guidance in that. We like that we're not seeing fractures or cracks in the surface and the foundation we're all standing on with the economy. But average GDP going back to the 1940s before a recession, the quarter before a recession was 2.7 real. So that gives you the appropriate grain of salt as far as interpreting GDP. So I think you're talking about September going forward, going back to Goldilocks, there's a lot baked into market expectations right now. And we have multiples 10, 20% above historic multiples, never mind how far above we are recessionary type multiples. Again, that goes back to this being a nervous market, laser focus on the data. We have the smallest hiccup on NFP, on CPI. To your point, that could drive a weak September. That's not our base case. Again, our base case is S&P continues to grind higher, but we're on guard and we're being cautious and we're watching the data very closely, of course.
I also want to talk about sectors a little bit here because you look at the month to date, it's pretty fascinating what you're seeing in terms of investor flows here. You do see some of that broadening trade occurring. You do see consumer staples, real estate, financials, utilities, healthcare, all doing better, but energy and consumer discretionary really lagging behind. When you look at September, do you extrapolate from this? Do you see more of this? Or do you see some reversal in some degrees?
Good question. I'm glad you're getting into sectors beyond just technology. And so we like that broadening trade. That's very satisfying as a portfolio manager as far as the impacts that has on a well-diversified portfolio and long overdue. You talk about energy, you talk about discretionary. That's another good reminder that we are in this late cycle environment. Late cycle can go on for a long time, and that's the base case again. But you're also seeing these pockets of weakness in some places. I wouldn't extrapolate that too far. When we're looking at this broadening trade, GDP, earnings, the broader sentiment, optimism on rate cuts. What we're seeing here is Russell 2000 beat the S&P over the last 3 months. That's phenomenal. Even over the last month, you've even had international developed, the MSCI EFA index, beating the S&P over the trailing month. So that's wonderful to see in portfolios that sort of baton is being passed from the AI trade and tech trade into the rest of the broader market, not just US, but internationally as well.
Adam, we thank you so much for your time. That is Janice Henderson, Global Head of Multi-Asset. Adam Hetz, have a great weekend to you. We're going to take a look at some movers this morning because, yes, we are up on the S&P 500, but certain stocks are certainly down on the day. Lululemon in particular, we were talking about it. People had thought here that the cuts were really priced in, but now we're seeing the stock lower by 1.7%. MongoDB just on a tear, Katie, up more than 17% today after promising earnings results here. You are seeing very interesting movement in the tech sector. I would also note, not on this board, Dell as well, flying higher. Ulta Beauty now down 4.4%. I know you were watching that. We both love to buy makeup. And so obviously Berkshire Hathaway has loved to buy Ulta as well, but not feeling the love from that stock today.
Definitely a summer Friday with Shonali and I just going into our spending habits, but definitely some interesting movement there at the single stock level. And coming up, it's being called one of the strongest turnarounds in retail history. We'll tell you what CEO is being credited for the positive pivot in today's top calls. This is Bloomberg.
Names in global leadership are on Bloomberg.
We are 40 million, we're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, Citi upgrading Abercrombie & Fitch to a buy. The analyst says that Abercrombie had one of the strongest turnarounds in retail history, adding that CEO Fran Horowitz has shown she has her finger on the pulse of their consumer. We spoke to Horowitz earlier this week about the turnaround.
We've spent a lot of years transforming this company and really rebuilding our operating model. And we've spent time and time again with the investors really explaining and helping them understand what all of that means. What that means is staying close to your customer, making sure that we're reading and reacting to the business, having financial discipline and how we control our inventories. It's a new way of thinking about retail, and our operating model continues to drive results.
And next up, Morgan Stanley says the Dollar General is no longer a buy and shaving its price target by $70. The analyst says that there is greater uncertainty around whether the discount retailer can stabilize its market share position. Dollar General reported bleak second quarter sales weighed down by a weaker low-end consumer. And finally, Raymond James cutting its price rating, its target on Ulta Beauty to outperform, and cutting its price target by $50. The analyst citing the impact of competition and a softer macroeconomic environment. Ulta trimming its sales forecast as more consumers cut back on cosmetics. And let's discuss this now with Bloomberg's Afanasieva joining us. And I'm really curious about just the context and the contour of this year, because in the first quarter, it seemed like beauty was where you want to be. And obviously, you take a look at the shares since then, and something has changed here.
Absolutely. Yes, it's both a structural change and a change that's Ulta specific. On the one hand, you've got consumers trading down and spending less and experiencing weakness after a strong period of inflation and high interest rates. There's, of course, the dupes that we all know. Why spend a lot of money on a product where you can have the Walgreens equivalent with the same ingredients? They might not be of the same quality, who knows, but they cost a lot less. And then in Ulta's case, it's been complaining about having Sephora shops open, for example, in the same area. So they're having to work harder to compete for their piece of the pie because it's just such a competitive sector in beauty and skincare.
At the end of the day, when you look at the stock price reaction, down another 3% and bringing the year-to-date declines to almost 30%, Dasha, how much needs to change at this company to change investor sentiment around it?
I mean, it's rare to see such a sharp downgrade, and you sort of wonder how could things have changed so much in the last month that you're forecasting, a decline of 2% rather than up to a 2 to 3% increase in sales for the year. So I do think a sort of a more radical overhaul is probably called for, or I'd be calling for it if I were an investor. But on the other hand, if part of problem is that there are Sephora stores close by, you can't very well overnight up sticks and leave and change the location of your stores. So I think that it's about a cleverer marketing strategy and definitely promotional activity, which of course will have an impact on margin. But I think that the company's got to unveil something that will at least convince investors that it's doing well in a tough market rather than doing poorly in a very tough market.
And I want to build on that conversation because you mentioned the competition and you mentioned marketing. And you think about what's going on over at Sephora, of course, one of the biggest competitors to Ulta, and it's TikTok. I mean, it has just gone absolutely viral. And when it comes to how Ulta sort of climbs this mountain here, I don't know how you engineer a viral campaign. It seems like a tall order.
I think, yes, it's TikTok, which you have to know how to do. And I guess it's a case of hiring executives who get it and who get how to market this way, how to market to these generations. I think also, if you look at some of the beauty retailers they've done in the UK, Space NK is fighting back. And they do quite well on membership and on expertise. And membership cards are a way to also drive consumer loyalty. I think data is a massive one. In this result season, one of the things I found most interesting was Walmart talking about how they're using AI to predict the demand for products, where I think they said it was they could use 950 million data points created or improved using AI. And if they had done this with human, it would have taken way more people. So I think it's that kind of smart investment. But you're right, it's definitely an uphill struggle in a very competitive space.
Dasha, we thank you so much for your reporting. That is Bloomberg's Dasha Afanasieva. Very sorry. Thank you for your time. Now coming up, Izzy Englander picks his next fund to back. We're going to have details next on what's going on in the world of hedge funds in today's Wall Street Beat. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Let's take a look at stocks about 22 minutes into the U.S. trading day. You can see a rally on our hands right now, led by big tech. The S&P 500 up about 0.6%. The NASDAQ 100 up about 1% at this moment after a very volatile end to this week. It looks like we'll end in the green if this holds, but you never know. You take a look at the small caps getting in on the action, but to a lesser degree. The Russell 2000 currently up about 0.3%, Sonali.
And it's time now for the Wall Street Beat. Izzy Englander has been making a lot of news this week. His Millennium Fund is backing another external investment firm. It's been happening in a string of investments, but this time he's backing a technology-focused hedge fund, Analog Century Management, headed by Val Zlatev. Joining us now is Bloomberg hedge fund reporter Nishant Kumar, who has been reporting on this, let's say, phenomenon, because you have Millennium that has its own pods, and now you have Millennium looking to external managers. Why?
Well, that's a very, very interesting question, and that's the hottest trend in the hedge fund industry right now. It was not meant to be like this. In an ideal world, Millennium would want all these traders to come inside and trade for them. But there is a huge talent crunch going on in the industry right now. Not everyone is available to be hired. People have their own ambition to run their own firm. So this is Millennium's second best option. Everyone is doing that, but Millennium is the most aggressive hedge fund to allocate capital to external managers, roughly about 1/10 of their investment teams, and there are 330 of them are external now.
That's absolutely fascinating. And this all comes against the backdrop, Nishant, of a very volatile August. And Millennium is one of the larger hedge funds also that has actually had to close some of its own pods this month after the turmoil we saw. Can you explain what we've seen this month?
Yeah, absolutely. So Millennium we have reported 3 pod closure. To be fair, I mean, they have more than 330 of them. So it's still a very tiny number of people who have been let go. And it always happens whenever there is a market chaos, some or the other trader will get caught. He loses a little bit of money, and all these hedge funds run with really tight risk limits. Like you lose 5%, your capital is cut. If you lose 7%, you are out. So whenever traders find themselves really vulnerable in this sort of a market that we saw in August, and that's what happened across platforms, across industries. We have seen people being stopped out and fired and losing their pods.
Nishant, we're going to have you back and early next week to talk about what this all looks like. Of course, month end means month end returns as well, Katie.
Yeah, it's going to be fun to talk about that one. Bloomberg's Nishant Kumar, thank you so much. And let's get to the trading diary, what you need to be watching next week. And I'm thrilled to report that on Monday, it is Labor Day and U.S. markets are closed. Then we're back in action on Tuesday. We get ISM manufacturing data for August. On Wednesday, we get earnings from Dick's Sporting Goods and Dollar Tree. Remember what we heard from Dollar General, so things might look, I don't know, a little bit dicey there. We also get JOLTS data, and that's ahead of the big one, Friday's U.S. jobs report. All eyes on that one. You take a look at where markets are right now, though, Sonali. We are in the green. You know, we got that PCE data, at 8:30 a.m. Eastern. Pretty tepid overall, and looks like investors are taking that as a buy signal. The S&P 500 currently up about 0.6%, and it's big tech that's leading the action right now.
No news is good news on the economic front, but next week is the big week. And you know what? A lot of people still might be off given Monday.
That's true.
They might want to come back.
God bless them.
And watch open interest.
We'll see, of course. Don't go anywhere, though. Coming up in the next hour, we'll speak to Elias Sabo. He is the CEO of Compass Diversified. Of course, the CEO of what some people call a baby Berkshire. We'll talk about all that and more coming up. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Rain World Cup. This is a story
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio.
Let's all talk at the same time.
We are off to a good start. No, the radio's not broken.
Let's get the bosses in right off the start. Like, come on, guys.
Wait, what are you doing here, Carol Master?
What are you doing here?
My alarm went off this morning and it said, time for Bloomberg Intelligence.
Mine said it's time to walk the dog.
Oh, okay. Well, we're here.
We didn't want to get up because it was earlier.
Alex and Paul are off doing whatever they do on Fridays.
Some people get to start their Labor Day vacation.
Hey, that's fine. I'm happy to be here. It's a great day.
Listen, it is a great day, and even though we're wrapping up the month of August in terms of trading, we have some good stories to talk about. Intel, Wham, this morning, what they are doing to kind of make people interested, investors, and I don't know, they got to figure it out. So we're going to talk about that a little bit later on.
Also, there's some Fed-friendly inflation figures out there. We're going to check in with Ira Jersey over at Bloomberg Intelligence. He's U.S. interest rate strategist. You just did. You can say it.
Hashtag.
Also, we got John Tucker in here. He's going to... Yeah, that's right. I know. We don't usually get to hang out with him.
I don't know who that... John? Oh, yeah, right.
Hey, so let's get an update on
starting out really
what's going on
yes,
with the markets.
A positive report on inflation. The core personal consumption expenditures price index strips out food and energy, increasing 0.2% from June. Chip makers broadly higher, led by Marvell Technology. That is up. Surge there after its latest quarterly results, hitting Wall Street's sales and profit targets. Dell also beating analysts' second quarter forecast, boosted by record server and networking revenue. Companies continue to beef up their AI infrastructure. And Ulta Beauty tumbling after its sales and profit fell short of expectations. Information technology right now the best performing major industry group in the S&P 500. The biggest drag in the S&P 500 right now coming from energy. That's because oil prices are falling. Reuters reporting OPEC Plus is going to ramp up oil production. in October. Right now, the S&P 500, 39 points higher. That is up 0.7% at 5630.
He's having mic problems. I don't know if you've noticed.
You're
It's a
having
Friday.
more problems than that. The NASDAQ 100, 247 points higher. That is up 1.3%. And the Dow Jones Industrial Average on course for another record right now of 44 points, up 0.1%.
Did you say record?
Yes, I said record.
Wow.
We had a record close for the Dow Jones Industrial Average yesterday and one the day before, 41,379 right now. And as far as yields after that economic data, 2-year up 1 basis point, 391. The 10-year is unchanged, 386. Little less inversionary, down 5 basis points.
Inversionary, is that a word?
Negative.
If John Tucker says it, it works.
5 basis
I'm
points
Googling that
between
I'm so
the
Googling.
two. So you're off to the Open
Oh, yeah.
today?
Yeah, back to
Oh.
it. We were there yesterday.
Guess
We're
who
gonna
wasn't invited?
John Tucker?
Yeah.
Next year, John. There's always
There's
next year.
always
And you know
next
what? There's
year.
another week of the U.S. Open coming up.
Can I just tell you, when you go
Please.
through the gates and you have to show your security badge, there's a picture of you posted up there. Like, don't let this person in.
Security. How was your $26 sandwich?
27.
It was really good.
I hope that's not going to appear on your expense report, Carol.
Cute crickets. No, it's not. It's not. You know, what's really cool is for media, we get part of our badge, we get like a spending allowance while we're there. It's like it's like being 10 again and getting an allowance, but it's kind of cool. We appreciate it, so we get to eat a little bit. Tim
Yeah,
actually
there's enough
brought me
money on there to
fries
buy half a sandwich. Yeah.
Your spending allowance. Mine would be liquid, but that's just me.
They do have discounted beers for media.
Okay, good.
I will say.
Do they? I didn't know that.
Yeah, they do. I'll show you where it is later.
Okay, all right.
It was a great day yesterday. We have a great day coming up. Some huge matches on Arthur Ashe. We got Ben Shelton and Francis Tiafoe, 2 Americans going head to head. There's a lot of pushback as to why this isn't actually happening like prime time at night.
I don't know.
Well, Djokovic is playing at 7 o'clock tonight.
Oh, that's why.
That's why.
When you're Djokovic, you can basically say when you're going to.
Who takes on the difficult
I don't know, I'm
names?
just
Do you
guessing.
just defer to Tim or do you defer to Carol?
Remember Karen Moscow? We'd always defer to her because she would do all these tennis players. We're Googling. We're getting some assists.
Hey, speaking of assists, a big thank you to John Tucker for that business flash. Some big news for our New England listeners. Bloomberg 106.1 and 1330 are moving to 92.9 FM. Starting September 3rd, listen to Bloomberg Radio in and around Boston. On 92.9 FM, it's your news source for business news from the financial center of New England. Bloomberg Radio, moving to 92.9 FM at noon, the day after Labor Day.
Yeah, be sure to be there because you're going to then always, every day, every trading day, going to find out about the market drivers, those stocks that are on the move. And we're going to get to that right now with Carmen Reinecke. She's Bloomberg Equities reporter. And we got to start with Intel, which is the number 2 gainer in the NASDAQ 100 and the number 1 gainer in the S&P 500.
Yeah, shares of Intel, that's ticker INTC. They're up about 8% right now. This is a pretty big jump, the best intraday in 3 weeks for the company. Basically, what's happening is that there was actually a Bloomberg News report saying that they're weighing options, including splitting the foundry to stem losses. So Intel's been really beat up this year. I think it's down about 56+% on the year. It's really struggled to sort of get any momentum in the AI trade. And discussing the scenarios to sort of turn things around is being viewed really
How
positively.
the mighty have fallen, right? We talk about this story a lot.
It's the end of I want to say the end of an era, a different era when you have Intel, bringing on banks to help make moves like this.
Right.
And then a company like NVIDIA, that's been out in full force for the last few years.
All right, so we're watching Intel. We're also watching Autodesk. It's up almost 4% in today's trade. Off its highs, but nonetheless rallying.
Exactly. So shares of Autodesk, they're up about 4.5% right now. This is ticker ADSK. The engineering software maker reported second quarter results that were better than expected. This also came after they've had pressure from Starboard Value, an activist investor that's pushed them for changes such as increasing margins and considering a new CEO. So shares up a little bit on that. Beating expectations is being viewed positively. Other one I wanted to look at today is CrowdStrike. This is ticker CRWD. It's off its highs of the day. It's up about 3.7% right now. It also had earnings yesterday. So the company reported results that beat expectations but cut its full year forecast. Still, it looks like shares are up because the outlook is still better than feared. This is the first report that we're getting after that huge outage.
It's not as bad as everybody thought it might be.
Yeah, well, this is the first report after that really massive outage.
Yeah.
You know, the blue screen day. So, obviously, really important. You know, time to get some insight from the company about what they're seeing. And it, you know, better than feared is kind of okay. You know, we want to see the pipeline, want to see the sales and revenue going forward. And CrowdStrike is, you know, considered one of the best in cybersecurity still. So
that's why that outage was also like, what?
Exactly.
Not supposed to happen. All right, good stuff. Carmen, thank you so much. Carmen Reinecke, she's Bloomberg Equities reporter, joining us right here in our studio.
Well, stocks climbing after the latest economic data showed the economy is holding up while still leaving the door open for the Fed to cut rates a few times this year. Bonds, little change though on this data. Let's get to the story with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. He joins us from Princeton, New Jersey. This PCE data that we got, Ira, largely in line with expectations. Does it change any of the moves from the Federal Reserve come September and later this year?
Well, I think it doesn't take 50 basis points off the table, but I think just given the whole mosaic of the data that this report gives us between income, spending, as well as the 2.5%-ish core PCE and headline PCE numbers on a year-on-year basis, that it makes it, I think, a 50 basis point cut as an initial cut a little bit less likely, particularly when you look at some of the spending data, because the spending data is suggesting that the consumer is still willing to spend, and you look at some of the sectors, and I was just actually taking a look at services and durable goods and the like, and durable goods sales really plummeted last year, but those have come back and are still growing at around a 4% year-on-year growth rate. So the consumer is still holding up the economy right now, and unless that changes meaningfully, I suspect that the Federal Reserve will move cautiously, but I do expect that they'll cut interest rates, but maybe not 100 basis points this year, maybe 75, which again isn't a massive change, but I think that this data, points to the soft landing being more probable than it was before we saw it.
Ira, I'm always curious about, in terms of Fed policy, 25 basis points versus 50. Is it better to kind of spoon feed slowly when you're shifting in cycle, when monetary cycle is shifting? Is it better for markets, investors, and the economy, or is it better to kind of give it a jolt like 50?
Well, typically, the Federal Reserve is cutting interest rates during some kind of crisis or massive downturn, or when there's some kind of exogenous shock that occurs to that might make the economy really slip into recession very quickly. That is not this situation, right? So this is different than most other cycles that we've seen over the past 40 years, and because of that, I think there's some people who say, oh, well, they'll cut 50 because they're behind the curve when you look at some data. But then you look at the data that we saw today from July, right, which is the first read on how third quarter GDP and the like are shaping up. And it was decent. Not spectacular or anything, certainly not like it was a year or 18 months ago, but definitely a decent number. So Carol, to your point, I think, them going slow to start, and then if the economy does slow down more significantly, they can cut more later. I think that they'll be more cautious than not, and that's one of the ways that I differ from some of our colleagues over at Bloomberg Economics. But nonetheless, like the Federal Reserve is in easing mode. They're going to be easing. Inflation at 2.5%, core inflation at 2.5% is close enough to their target that I think that they're comfortable, to start easing monetary policy now.
Well, just in the last 11 minutes, we got consumer sentiment data. It showed that it improved in August for the first time in 5 months. Slower inflation and prospects for the Fed interest rate cuts helped lift expectations about personal finances. Ira, consumers expect prices are going to climb at an annual rate of 2.8% over the next year, down from 2.9% expected last month, and the lowest since the end of 2020. The data out Friday showed. Again, good news for the Fed.
Yeah, so certainly, the Federal Reserve looks at expectations for inflation as part of its analysis of what it needs to do with monetary policy, and certainly consumer expectations, like the Michigan inflation expectations component, is one of those, along with the market. Now, when you look at the TIPS market, and we put out a note about this last week, looking at the TIPS market and what it's been priced pricing, and it's pricing basically 2% inflation for the next decade. Now, tips haven't been the greatest of indicators of where inflation is going to go. And in fact, if you had actually bought tips and tips break even, so the inflation rate that the market expects back in 2021 when inflation started to go up, you would have made a killing because the inflation was meaningfully higher than what the market was pricing. But nonetheless, like at this point, most inflation indicators, forward inflation indicators, are moderating somewhat, and because of that, I think it's another reason why the Fed isn't concerned about a reacceleration of inflation at this point.
All right, so check. The Fed's got to feel pretty good about where inflation is, dare I say Goldilocks. But the one thing I am concerned about, and I know you watch it as well, is the jobs market. And we get another read, of course, the monthly report just about a week or so from now, or a week from now, I should say. Having said that, Tim and I have conversations with people saying that that they're finding it's harder for people to find jobs, or they're getting a lot more job applications. Just 20, 30 seconds. Should we be a little worried about the job market? Real quickly.
Yeah, I think so, and certainly the Fed has pivoted that way. Jay Powell was absolutely unequivocal about that last week. A year ago, we were only worried about inflation. Now the dual mandate is back in play, so any weakness in the job market will make the Federal Reserve worry that the economy is slipping, and therefore will cut interest rates.
All right, Ira, thank you so much. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey joining us from Princeton, New Jersey.
All right, back to Intel we go. We mentioned it. We talked about it with Carmen Reinecke. What's going on with the stock? It's up more than 7% in today's session. It's a top gainer in the S&P and the NASDAQ 100. So let's talk about the news that really, we thought it was going to be a sleepy Friday. Not even close. So with us is Ryan Gould. He's Bloomberg Deals reporter on Intel weighing a bunch of options. So Bloomberg exclusive, kudos to you guys. So talk a little bit more about what they're considering and what this means. Is this a good thing, bad thing, or we still don't know?
Carol, I think it's the biggest story in tech generally right now. I think if you look across the board, and you've seen the reaction today with the stock, I think Intel's obviously up. Semiconductors in general are up. I think Broadcom was almost up 4%. This is a name that is being closely watched. There's been some commentary, and as we've been speaking to sources around this idea that Intel is too big to fail. Getting back to, what happened in 08. This is kind of this is almost getting to that territory. This is a big name for sort of national security almost for the United States. Intel itself accounts for 41% of US 300 millimeter wafer production. This is a name that, really is.
Meaning we need Intel to be a healthy company. We need a domestic, massive semi company.
Indeed. And I think that's what's at the top of all of this. And so the pressure on Gelsinger is enormous.
But it's a lot less massive than it's been in the past at this point, especially after this year's stock decline. So Ryan, let's talk a little bit about what the options are from, and again, the bank is working with, or the company is working with banks like Morgan Stanley and Goldman Sachs. What are the options that these banks are laying out for the company?
Yeah, and I think just at the top, I think it's good for us to note that Goldman and Morgan Stanley have been Intel's advisors for a long time. They took the company, they've been around. They've been around the block. They know a lot.
Long relationship, know the company.
Yeah, exactly. And I think some of the things that they're talking about with Gelsinger and the board would include things such as a split of Foundry and the product design unit. That would be
meaning huge, separate companies.
A separation, yeah. So being run, it could end up being a spin-off.
Why is that a good idea?
I think because Intel has seen pressure in recent weeks and months around this idea that the turnaround, the costs required for the turnaround in and around manufacturing itself of the actual chips is costly. One fab that they're taking money for takes about $20 billion to build.
I got to tell you, I'm just, you say too big to fail. In the context of companies that we've talked about recently, Boeing is a company that has been talked about as being too big to fail. Instead of spinning off, they're consolidating, bringing back Spirit Aerosystems, a company they spun off 20-something years ago. It just seems like, would these moves fundamentally change the fate of Intel? Or is it financial engineering?
I think it would, because you'd essentially be looking at, with a split of Foundry, you'd essentially be looking at a company that's only focused on the product design, which, i.e., the chips that you might find in a Dell computer or in a Lenovo computer.
So they wanted to be more like a TSMC, right? Making chips to be a Foundry.
That was key to Gelsinger's view, is that they wanted to rival TSMC. That so far, investors aren't convinced. Intel is still the only customer of Intel's foundry business.
Right.
Which, you know, the challenge so far has been how can we get chips out the door at a fast enough rate for other customers that aren't us?
So if they do that, what's left in terms of Intel, their secret sauce or their chips that they are making? You know, it's interesting in a week where we focus so much on NVIDIA. Is that enough of a business? Is that a better business? I understand it'll be more of a pure play, not all the costs of building out foundry. 30 seconds here. Is that enough of a business?
It is, because you'd essentially be looking at something that, you know, where they've lost ground to the likes of AMD and then around GPUs and CPUs, they could focus more time on the data center server type area.
Well,
and that's huge.
Investors are buying in today. Intel shares are up about 7% as we speak, but let's not talk about where they are year to date because they're down a lot. Ryan Gould, thank you so much. Deals reporter, Bloomberg News, a Bloomberg exclusive. Read all the deals. Just head to Bloomberg.com or check it out on the Bloomberg terminal. This is Bloomberg Intelligence. Carol Masser, Tim Stanovic. This is Bloomberg. This is Bloomberg Intelligence.
headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. The Federal Reserve's preferred measure of inflation rising at a pretty mild pace. Household spending did pick up in July, so this all reinforces policymakers' plan to start cutting interest rates next month. consumer sentiment. We got those figures at the top of the hour. Improving in August for the first time in 5 months. Slower inflation and prospects for interest rate cuts, helping lift expectations about everybody's finances. Among the movers today, Dell Technologies reporting second quarter results. They beat expectations. Dell shares right now, they are up 1.5% in the early going. Some of the other stories we're following, Ulta Beauty shares, they're dropping. The cosmetics retailer trimming its sales forecast following weaker than expected second quarter results.
I don't understand. You know, Tim uses so much in terms of cosmetics and skins and potions.
Yeah, I know.
You
so
too,
does John.
right?
I get everything from John.
Sunscreen.
I get everything from John Tucker. So
You guys are goopy.
Why
right?
would you cover up this face?
I
great
often
question.
ask that.
Anyway,
I
you're
often
pointing to
ask
your
that.
face, not my face.
Right? You do look like Ken. No, you know what? You're making you look like my great aunt after they laid her out of the funeral home. Anyway,
Why is everyone in the control room
it was a good look.
laughing at me?
It was a good look for her.
Everybody's just laughing at me.
It got a little chilly in here.
S&P 500 up 30, the Dow up 52, adding to its gains, a record close from yesterday, and the NASDAQ 100, 174 points higher. We mean it with love, though. We check the markets for you all day long, right here on Bloomberg Radio and at your Bloomberg Business Flash.
You only kid with those that you love. I totally agree with that.
I think what's interesting
When they
about
don't
this
kid, they
is
don't like
they don't
it.
allow John on our show later. Like this is
Because they get mad because
well,
we
they
want
don't
to just
like
talk
it when
with
we're all
John.
together.
I know. It's,
Who's
Yeah.
they?
They.
Are they?
they're like, do I have to separate you three?
What happened?
I know. I'm just, anyway. All right. John, we'll get back to you in just a moment. John Tucker, the amazing John Tucker right there. All right. We're going to talk a little bit more about what's going on in the markets, Fed expectations, because it does feel like the inflation report, the preferred inflation gauge of the U.S. Central Bank, coming in, we're still seeing consumer spending, inflation cooling. It does feel like Jay Powell's got to feel pretty good going into this Labor Day weekend.
Somebody who watches this stuff so closely, the macro and the micro, is Ben Emmons, founder and chief investment officer at FedWatch Advisors. He joins us from Washington, D.C. Ben, I think you write more than some journalists I know. How much of your day do you spend writing?
I spend, I think, probably a good 80% of my day on that. It's just like, I'm just this addicted writer, I think. I listen to you and Carol and John and other people, and that actually is always a really good inspiration for writing. Obviously, checking numbers and markets. And yeah, it's just enjoy doing it. So it's always focused on analysis, right? It's always focused on trying to come up with another angle to the story, like what we're looking at now at PCE, and try to drill in and try to come up with practical ideas about it. And then obviously extrapolating that to what I do now, I decided to set up my own firm and really focus on Fed watching, making that more like an investment firm around Fed watching, and apply that writing. And as a last point there, I do want to say this. As you know, I used to work for Bill Gross at PIMCO for many years. He taught me actually this. He did that himself too. He's one of the most prolific writers too. He would always tell you, write out your thoughts, because that gives you really the sort of your let's say compass to navigate these markets.
I do think that there's something really healthy in also, like, we joke about putting your phone down or sitting and writing something and just walking away from the day-to-day barrage or minute-by-minute barrage of headlines and statistics to try and just kind of think about where we are in a sane way.
Well, Ben, there's a synthesis that happens when you sit down to write about something. I learned this in high school. I think one of my teachers said, you don't really know something unless you can explain it or you can write about it, Ben. And that's what you do with your notes, and that's certainly why I appreciate getting them pretty much every day. Just to give you an idea of the types of notes that Ben's written recently. He's written about the data center surge. He's written about NVIDIA's economic impact. And I know he's listening to our show because he forwarded me the NVIDIA economic impact note after we were talking about NVIDIA's economic impact on our program a couple days ago. The uncertainty when it comes to IPOs, reflation when it comes to shipping, and of course, everything happening last week at Jackson Hole.
Yeah, exactly. So let's start with NVIDIA, because it has been, we even kick off our weekend show saying, listen, folks, there was one story pretty much this week, and that was NVIDIA's earnings. How do you extrapolate that out, not only to what it means for NVIDIA specifically, but the AI race, the AI build out, and what it maybe says more broadly about CapEx spending and, I don't know, and what it means for financial markets when that big, tech trade means so much?
Yeah, that's right, Carol. I think that, the Wall Street Journal had a nice graph on that showing all this tech spending and the projection of it. And it's all based on NVIDIA, literally on expectations on how NVIDIA will perform from here, because they have the monopoly on those GPUs and chips and Blackwell and all the things that they create. And yet, as they create those chips, as we now know, there's on the ground all these data centers being set up across the country. And that was one of the graphs I put in the note, all those bubbles out there. And that's not just a data center that I guess I want to visit one of those actually. It's kind of interesting new concept, but there's a lot of people that start working there. There's a lot of services that then happen around these data centers. So NVIDIA has become a major macroeconomic force in my view, where you could talk about the stock and the multiple and the earnings projections and all those things and everybody in the bar in Manhattan was very excited about that. But me as an economist, Fed watcher, I think of it, this is a company that's become very powerful for the economy, that if its performance were to change and the expectations about its growth changes, that could have an impact on the economy in itself. It's like Boeing with its impact on the supply chain. When people have calculated that it's worth up to 0.5% of GDP. I think NVIDIA could be actually more impactful.
Well, I think about that, those data centers that are the big build out, right? And do we all of a sudden, maybe in a year or two, are they not actually operating? Are they a little quiet because maybe the reality doesn't live up to the expectations? So that's certainly top of mind. The other thing is we got to talk politics.
Yeah, I don't see a recent note, Ben, that you have about this. You had something about Harris a couple of weeks ago. It's coming. Okay. Well, here's what I want to. Let's get a little preview from you on this, because Bloomberg News Morning Consult poll came out late yesterday, shows that Kamala Harris has sustained the burst of momentum she brought to the presidential contest. She's leading or tied with Donald Trump in each of the 7 swing states most likely to decide the race. How do you think about economic policies under a President Harris versus a President Trump?
Yeah, the first thing you think of is that, okay, she just extends what we've been doing so far with Biden. And yes, the Infrastructure Act and the CHIPS Act will not be disrupted, right? Which is, I think, back to the NVIDIA story, an important aspect, because there have been slowdown in some of these chips activities recently, meaning there's a lot of semiconductor investment that's happening in the States, but some of these projects have been put off. The Financial Times report on that. So that's key, I think, because from an economic policy point of view. Then, of course, everybody looks at the Federal Reserve and its independence. You will not rail against that. I think for the broad markets, that probably matters not as much. It's more about then further down about how are you going to go after people with higher taxes, right? Are you really going to increase capital gains taxes and wealth taxes and that sort of discussion? And I think lastly, it's really about her own agenda in terms of like how she's shaping it. And we're getting some contours of it. She does seem to be in favor of fracking, for example, which matters to energy supply. And she is going to address the border, which could affect immigration flows, right? So I think if you take all those things, her agenda is the extension of Biden, but it is her own agenda. But the most important thing for me, at least, is I think that if there's no disruption in what the Infrastructure Act and CHIPS Act are doing to the economy, that will matter a lot, because that's really been a big driver, I think, for economic performance over the past year.
Listen, I think about, Tim, the conversation we had on Bloomberg Business Week with the Wyndham Hotels CEO, who said some of their development, especially for extended stay hotels, was specifically tied to some of the congressional spending plans that have come from the Biden administration. In other words, whether it's infrastructure or so on and so forth, that places are building out, companies are building out throughout the nation, Texas
He joined us from
specifically.
Frisco, Texas. Yeah, you're talking about Jeff Bellotti, who was on with us last week or the week before.
Right. So what you say in terms of these plans, whether it's data centers, AI, whether it's climate change, renewable energy, these spending plans are certainly key in terms of economic growth and keeping kind of the engine going. Having said that, what is the one political policy, whether it's Donald Trump or Kamala Harris in the White House come November, that you think is going to be very important to keeping the economy in a good place here in the U.S.? And just have about 40 seconds.
Yeah, it would be the debt ceiling negotiation and how fiscal policy will be shaped into 2025? Because remember, the debt ceiling negotiation last year had a 1% sequestration attached as part of the negotiation. Will that sequestration, which is a spending cap, will that be like what we experienced in 2011-12, like a larger one? Because if that's the case, that would have a significant impact on the economy. Doesn't seem that that's the case, right? That both want to spend more, but that is a really important aspect, I think, of as we go through the election. How will fiscal policy play the role in the economy?
Yeah, and as we know increasingly from guests, it is an important one. We've talked about it in the past, but it's a much more, in terms of the deficit and so on, it's going to be potentially more problematic. Ben Emmons, thank you so much. Keep the notes coming. Founder and Chief Investment Officer at FedWatch Advisors, joining us from Washington, D.C. We're going to switch gears and go back to a name that's on the move in this market.
Yeah, in just a few minutes, we're going to be speaking to Woo Jin Ho about what's going on with Dell. Shares higher by about 2%. Before that, though, let's get a check on the latest world and national news. Michael Barr, what a treat. He's in here in the Interactive Broker Studios. Hey, Michael.
Well, a morning to you all. Tim, Carol, and John. Vice President Kamala Harris is leading or tied with Republican Donald Trump in each of the 7 states most likely to decide the presidential race. The latest Bloomberg News Morning Consult poll shows Harris now leads by 2 percentage points among registered voters across the 7 states. She is ahead by 1 point, a statistical tie among likely voters. We get more from Bloomberg's national political reporter, Greg Cordy.
This is the poll that we did immediately after the Democratic National Convention last week. Pollsters tend to look for moments like that to see if there's a bounce. Traditionally, presidential candidates get a little bit of a boost in the polls right after accepting their party's nomination for president. And in this case, we didn't really see a huge bounce.
Bloomberg's Greg Cordy. Vice President Kamala Harris defended shifting away from some of her more liberal positions in her first major TV interview of her presidential campaign. On CNN, Harris talked about changes in her policies over the years, specifically her reversals on fracking and decriminalizing illegal border crossings. Donald Trump is set to appear tonight at the annual gathering of the group Moms for Liberty. The national nonprofit has spearheaded efforts to get mentions of LGBTQ identity and structural racism out of K-12 classrooms. A Dallas police officer has died. 2 other officers injured by a suspect north of the city after a vehicle chase. Officers arrived on the scene after a call for assistance. Officers got there. They found one of their own had been shot inside his patrol car. Kristen Lohman of the Dallas Police.
Our department is hurting. We have officers who are injured, who are in the hospital, and we lost one of our own.
The suspect shot and killed. Global news 24 hours a day whenever you want it with Bloomberg News Now. markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. 9 of the 11 major industry groups in the S&P 500, they are higher right now. Information technology in the lead, and that is home to NVIDIA. Right now, those shares up 1.9%. In fact, the best performing shares in the S&P 500, shares of NVIDIA, I should say, getting a 2% pop right now. This follows the Bloomberg story. Intel also getting a pop right now. Those shares are higher, getting a pop after Bloomberg reported the company considering, among other
Can I have
options.
a pop with a straw, please? No, no straws, actually.
What's the alcohol drink that you were drinking on the company time at the...
I was not drinking it on company time.
PCE today coming in largely as expected. Headline prices were in line, while the year-over-year change in core just a smidge lower than the economic forecast. OPEC Plus likely to increase supply starting in October. This according to a Reuters report. As a result of that, you have NYMEX crude down 3% right now, 73.81 a barrel. And the Dow Jones Industrial Average on track for another record close. 87 points higher right now. That's up 0.2%. The S&P 500 up 37 points. That is up 0.7%. The NASDAQ 100 right now 215 points higher. That's up 1.1%. Doing these market checks for you is kind of like spinning plates.
Why?
And riding a unicorn.
Because you're doing so much at the same time, trying to focus on...
No, because there's so many distractions. I'm going to fall off my unicorn and break my plates.
Unicycle.
Or whatever it's called.
Are you saying we're distracting?
That's such your middle
We're just
name.
trying to... We're just trying to focus.
You're like, hey, John.
You're trying to focus. Try harder.
I know. Well, you know,
This is a very fast-moving show.
when you speak, we just like are listening to every word, and
Yeah.
it just makes us.
You're having a conversation
you
behind
pull
my...
us in.
No, you're not even close.
Are you done?
Yeah, I'm done.
If you were
I'm
listening,
really
Carol,
done.
you would have known that he's done.
I am listening. Did you talk about Dell at all?
Yeah, well, Dell after earnings right now 2.1% higher.
Not too shabby.
All you have to say is artificial intelligence and some of the focus there.
I know. We're like so easy. Investors so easy sometimes. All right, John Tucker, the one and only who can do spin plates, watch
Ride
for
a unicorn
unicorns.
and a unicycle.
Yeah, exactly.
Really,
and do
really
it
impressive
backwards
guy.
in heels.
In heels?
Don't you remember Fred Astaire and Ginger Rogers? She did everything that Fred Astaire did, but she did it backwards and in heels, which just says, we women, pretty amazing.
Do I remember?
I'm not saying. It's like a famous... all right, we got to move on. Let's talk about Dell. Can we
who they are?
Can we talk about Dell?
Yeah, as you just heard from John Tucker, Dell shares are higher. The company did report better than expected revenue due to an increase in the sales of servers built for handling AI workloads. We got with us Woo Jin Ho, Bloomberg Intelligence senior tech analyst. He's here joining us from Princeton, New Jersey. Woo Jin, give us the high level, and then we're going to get to the various notes that you wrote about Dell post earnings. Give us the high level recap of what we heard from Dell last night.
Sure. So the big lead into the print was AI server margins, or ISG margins in general, and the beat there was 11% ISG margins. Last quarter, they did about 8%. From a revenue basis, there was a 4% revenue beat, principally driven by AI servers. They did about $3.1 billion in AI server revenues, and I think the consensus was around $2.4 billion. So that's where the upside was. There were some, negatives. The PC market isn't going as well as one had hoped, but it seems as if the street is overlooking that a little bit. But all in all, AI is doing fairly well for Dell.
Woo Jin, you mentioned PCs, AI PCs. You know this. We spoke to John Rose earlier this week, and also, can I just say,
what?
We got some great questions from our Bloomberg Intelligence team ahead of that interview.
For John?
Oh,
yeah.
Yeah.
And he's right in the thick of it.
He's right in the thick of it.
So
but one
great.
thing that we asked about, Woo Jin, was about AI PCs. Is this something that there's promise in, that we're going to be using PCs that are equipped for AI, or is this stuff going to be on our phones? Like, is Dell right in thinking that there's going to be a big market for AI PCs?
Well, I don't think there's going to be a choice, Tim, primarily because Intel, AMD, they're all making AI PC chips. And Dell, HP, Lenovo, whoever the PC OEM is, they're going to put them in their PCs. Now, are they going to charge a premium? A slight premium, right? But like it or not, we are going to have an AI PC. The better question is, are there going to be apps that's going to help support the power of the AI PCs? And that's the $100,000 question that I have right now. The big uptake is probably going to be more on 2025 as a driver, calendar 2025 as a driver, than on 2024.
That's yeah, because I keep thinking, why do I need an AI PC, or will I need it for work?
Oh, Carol, you will need it for work. Okay. Just imagine the amount of time that you spend on your emails just to catch up on emails. Imagine once you open up your PC, it'll create a dossier of all the things that you need to do, all the questions that you need to have ahead of all of your interviews, right? All on a single page.
When? Tomorrow? I guess tomorrow's Saturday. Tuesday when I'm back?
Well, AIPC could probably expedite that, but let's see what Microsoft does or any other.
Will it help them focus?
What are you saying? We're focused.
Productivity.
Wait, what was that?
Productivity. It's all about productivity.
But so that's practical. Like Tim and I kind of joke about it, but we do think, wow, boy, it would be great to have something, just write some of our introductions or suggest some questions. When will it be reliable though, that we can trust it? I'm a little nut about the source of things and, making sure it's accurate.
Accurate. You are accurate with that statement.
Silly.
Still unclear when we'll get there. But given how powerful these large language models have become, I do think that it'll be relatively soon. Maybe back half of 25 and 26, we'll start seeing a proliferation of applications to help support the IPC movement.
What's going to be the learning curve on that, Woojin?
Should be fairly quick, right? It's almost like a search engine, let's just say. But once we learn the AIPC language prompts or the Copilot language prompts, I wouldn't be surprised if the learning curve is fairly easy.
You keep making references to Microsoft. Is Microsoft going to be the big beneficiary of developments with this AI hardware?
Well, they're already in there, right? If you think about what Microsoft has done with Copilot and integrating with their Office suite, they've made a big push. And keep in mind, they have a big investment in OpenAI to help support that, right?
Sometimes I think about
$10 billion.
Dell's history, and it's pretty remarkable. I mean, this stock's up almost 50%, 50 year to date. It just feels like it has, reinvented itself a little bit.
Oh, no question. I mean,
it's remarkable
you
where
talk
it
to someone
is,
around my age,
right?
and you talk to them about Dell, and they associate it with that ad campaign that was out like when I was in junior high. Like, dude, you're getting a Dell, right? One of the competitor. Right. It could have had the fate of Gateway. Let's just say that. Right. Like Gateway and Dell were the big players, Woojin, 20, 30 years ago.
Yep. And look, Michael Dell has done a fantastic job in reshaping the company from a PC maker to a general enterprise or corporate IT maker, and now it's reinventing itself as an AI server maker. Now, keep in mind, if you think about all the AI server makers in the world, there's only Supermicro is probably leading the pack. But if you look at the AI server revenues that Dell has, it went from $1.5 billion last calendar year, and it's on track to do about $10 billion in AI server sales in this calendar year.
So Supermicro's woes, do we have to be worried about Dell at all because of that? And just got about 25 seconds.
Yeah, quick recap. From a financial standpoint, no. The earnings report kind of helps us out there. Supermicro's margins were down on a sequential basis, but Dell's margins were up, and that kind of swept aside those concerns.
All right, cool stuff as always. Listen, thank you so much. Always love checking in with you. Woojin, have a great weekend. Woojin Ho, he's Bloomberg Intelligence Senior Technology Analyst joining us, from BI headquarters in Princeton, New Jersey. Dell shares, by the way, as we said, up 47% here in 2024, so way outperforming the broader market as well as kind of the tech indicators as well. It's up about just shy of 2% right now, so well off its highs of the day.
Hey, next hour on Bloomberg Intelligence, you heard us mention that Bloomberg News Morning Consult poll. We're going to be checking in with Kaylee Lyons, Balance of Power co-host, to give us the latest when it comes to that poll. That's in just a few minutes on Bloomberg Intelligence.